Good morning, it's Friday the 3rd of October. Welcome to Trade Live with IG, myself, Rich McDonald, and...
Welcome back, Batman and Robin, back on the show. It's Friday, but as the boys are saying on the comments, weather not great, so...
Oh, that's right, we're getting a weather forecast from a global weather forecast.
Yes. Great
day from Sydney. Friar Tuck, I'd forgotten that you dial in from Sydney.
Yeah.
So what time is it? Tell us what time it is there now. It must be 6:30 p.m?
Yeah, so I was 6:30 or 8:30.
Is that you just finishing your Friday, finishing the day, getting there? Oh, there we go.
Yeah, there we go.
Beautiful.
Not unlike Gloucester. Damp, drizzly, not quite as much fog.
How are you?
Yeah, good. Really good. Nice to be back.
Been on for a while, actually.
No, it has been a while. Nice break for the viewers, but now we're back with a bang. Autumn's coming, but that doesn't mean that there's going to be nothing going on. No, really good to be back again. Glad to see you've survived your trips to Munich and got back unscathed and that kind of stuff. So
I see Jesse 14 telling us, Guten Morgen, liebe Leute. That means my darlings, doesn't it? My love, my darlings.
Liebe, yeah, I think darling is, I think Liebe is darling, yeah. No, love. So it's morning, love, loiter. Well, I'm not sure what loiter is, but yeah.
Fluent, aren't we?
Fluent. Honestly, multilingual on this programme. Yeah. And I've been enjoying the podcast as well.
Yes, so yesterday I was podcast day, of course. Thursday mornings I am with my two friends.
Yeah.
So CJ, don't know if you're on, but CJ was being very chairman-like yesterday.
He's becoming very statesman-like, isn't he, in that role?
Absolutely. So it was the quarterly review because it's the end of September.
Okay.
So much like myself used to do with Rod every morning.
Yes, that's right. Yeah.
We went through every single position. There's charts in there in the show notes. There's a lot of detail of what we think of every position that we've got, whether we should keep it, whether we should kick it out, whether we should reduce it, increase it. So it's the first time we've done that. It's the first end of quarter we've had. So I think anybody who's interested in the views of CJ and Spice on a wider picture of everything, it is a really good episode. That will be live with you around about 4 p.m. this evening.
It does also prove, though, as well, that everybody needs to review, adapt. You can extend, you can move your expectations, that kind of stuff. But yeah, having the dialogue, I think that's the most difficult thing if you're trading on your own, like the viewers are.
Yeah.
Having that ability of the dialogue. And that's what I was saying to you earlier on. I love the Discord because everyone can sit and have a chat. So yeah, I think those updates are a really good thing to do. And as you say, if the pros do it, everyone should do it.
And that is the great thing about Maturin's Discord.
It's brilliant. I think it's really good.
Yeah, it's keeps the community going on.
It's a proper structured room. I was expecting some of the ones I've been on, which I've either been invited on or I've wandered onto. There's far too many memes and flashing cartoons and that kind of stuff, But yeah, it's a properly
distinguished group we're talking about here, isn't it?
Well, look, I mean, it is a properly well-run platform. So hats off to Maturin for being the kind of responsible adult in the room, because that in itself takes a lot of work, right?
Yeah.
And
absolutely.
all those little threads on the side, the different topics and stuff. Yeah, it's really good. It's really good. If anyone's not on it, you should get yourself on it.
Shall we have a look at what's coming up?
Oh, yes, let's have a look.
So Scotty and myself through with you until Expert Edge, Joe Chim, Hochim, Mr. Clement. Whack him. Are good. Now he can teach us a bit.
Actually, yeah. So what are you allowed to leak? What the topic's going to be for this week's one? Just yet, or do we keep the viewers?
Joe and I, or
no. For the well, yes. I'm sorry, Expert Edge for you.
Well, Joe. I'm hoping.
I really likes being called Joe, but
no, he does.
No, he does. Yeah, fair enough. Okay.
Yeah, so we're going to do an update basically on the current market situation, Europe's underperformance as we've moved back into this idea of US exceptionalism, and then what to expect with the shutdown, because of course he is our strategist extraordinaire.
Yeah.
And then Angie's going to do your US pre-market. I think we've got to rethink this pre-market, because of course we've got all ours now, don't we?
We do. I think. Yeah. I mean, look. I think it's got to be feedback led, because we have discussed this in your absence. I'm sure you discuss it as well. It's quite it's quite a difficult one to know if it should be a bit more thematic. I mean, we can focus on things that have moved last night. We've got the ability to see things that have moved in after hours, what hot stories are, themes. But I do think, I think because it's a daily thing and only 10 minutes.
Exactly. Yeah. So write into us what you think we could change that 10 minutes to, because of course it's US pre-market. Now we have the 24 hours. Is there something that we're missing? Is there something interesting that we could add in at 9 a.m. that you'd be keen to see?
Yeah.
Right. Shall we go into some overnight action, pal?
I think we should. We'll be wrong not to.
Right, who have we got on then? Jesse14 saying good morning, lovely people. That's what it is.
That's very generous.
Lovely people.
That's very generous.
Liebe. Scarpa dog, it's lonely out here. Where are you, Scarpa? And we, you are the only dog called Scarpa as well. I noticed in the comments yesterday. I was watching Luke Moore trying to pick apart our deal with the LSE.
Yeah.
Yeah, I had
Scoundrel.
I might not always be in the comments, but I'm always watching.
That's right.
And Poppy, good morning to you, sir. Chairman in the house, people. Everybody say good morning to the chairman.
Yeah, I feel like I should have a hat on or something so I could.
And yes, Rags is saying to us, gold.
Yeah, another high overnight. I mean, that's just nudging at the moment. That's just one way.
We had a couple of really interesting turnarounds in intraday price action yesterday. You've got one to take.
Yes, that's right. Yeah, I thought it was quite interesting actually. I'll just have to come out of what we were going to look at. We did look at the price action for Netflix yesterday. The last few days. Musk was on Twitter the other day very critical of some new content they've been bringing out and how he didn't agree with the nature of it, and so you should be cancelling your subscriptions. He's not quite as omnipotent as that, but the market did take, as you can see, that big dip down.
It's cracked, Scotty.
Oh, I'm sorry, that's our trading software. It's all right. It's not a new data card.
Yeah, I think if I scan that, I'm going to have to pay for it.
Yeah, exactly. I'll change that graph before it makes people's eyes go funny. But yeah, basically, you can see that sell-off and the gap down yesterday, but then it hit a pretty big level, which was support from a few weeks back. And then you can see had a very decent recovery higher. So that was quite interesting. The other, let's change the view. So it's a nicer.
Jump onto my screen there. You see it in Netflix, and so this sell-off since the start of October. So just to go back on what Scotty was saying, there's a new cartoon series.
Yeah,
and Elon has decided to chip in, telling people they should cancel their Netflix subscription. So we see as the market's gone up, this has actually dropped back about 3.5%. That's the kind of thing I'm really interested in.
Yeah.
So I think I'll actually, do you know what? 24 hours trading, Scotty.
Absolutely, live and direct.
Why wait? So we'll pick up a few of those. Oh, now you've got to remember that they are $1,100 each, because look at that. I've almost gone in to buy $174,000 worth.
Yeah.
So 15 shares. That'll do me.
That's why live trading is the ultimate buzz.
Wow. What would I have done then if I'd bought $174,000 worth? Always be careful.
Run straight to settlements and ask them to cancel.
That's right, yeah. I'd straight across. Let's go to a break.
Exactly, yeah.
Guys, can you just cancel that trade, please?
Absolutely. And then another reversal for a better screen that won't mess with your eyes as much as I did on my last one. We see the same for Tesla now. Flagged on the front page of the Times. They had truck deliveries out yesterday. Everyone's rushing to take advantage of the EV boom, and as we know, these things have had a huge move higher since Elon made a very timely investment in his own company a few weeks ago. But what's quite interesting is on here, you look at these two, you see that candle from back again, albeit this is December. This is a weekly chart. We've had to compress the price action, but you can see here that zone above around 430. You've got a big bearish reversal candle there. You had another one yesterday. Is this where the stock starts coming back to earth a little bit? Who knows? But that is a big move. I mean, that got absolutely ripped higher at the first 15 to 20 minutes yesterday at the open. but then got really heavily sold off. And
It's a huge reversal, isn't it? Let's just take a look at the way that played out. That's a real sign of, right,
enough's enough.
it's the start of October. We know these numbers are entirely good because of the end of the subsidies. So US numbers, end of subsidies on electric vehicles. This is bad for Tesla, because now all the good news is in the price. European sales have collapsed. US sales are now collapsing as we speak. Why would you buy a Tesla in October?
Well, this is it. And even on some of the opening slides that we had for the show, we saw the BYD sales numbers are slowing. So the whole, I say it might be seasonal. I don't know enough about seasonality around what the tax break looked like. But as Piers says, this is not a stock, so treat it accordingly. But however, price action is price action. And that is a very, very clear rejection of that high that we spoke about. So definitely one to watch after the move it's had.
Right, now you had a great article for us from the Times there as well.
Oh yes, on the digital ID card. So this is on the front page of the Times. We'll go to the business section because there's a few nice bits in there. But Palantir, the omnipresent voice in online security, has declined to get involved with the undemocratic digital ID scheme.
Undemocratic.
Whereby if you're an online security company, the fact that they take, and this is the head of the UK, to be fair, I've not heard of this gentleman, we've only really seen the CEO up on the share presentation. So this is Lewis Mosley, head of Palantir UK, and said, it's interesting that these firms are taking note of the backlash from the public.
Yeah.
And I know it's only at a proposal stage and all these things. I mean, most new policies now we know are floated in the media, right? And they see the reaction, so maybe this is starting to go away. But the fact for some of the people who are a bit older, the stories around how you and Blair will be in the front and centre, will be in the front and centre for providing the framework for this, and his dad Tony, who's got a bit of a tarnished reputation nowadays as a beneficiary. The whole kind of wind seems to be blowing against the sails of that one. But interesting for a company like that to come out and say something like it's undemocratic and we're not interested.
Yeah.
So, very interesting.
Andrew McKelvey's update on Nike. Well, it's obviously it's on the Tasty platform. I'll tell you what, let's get it up. So the Nike trade is the last trade I will do on my UK Tasty. Gutted. Right. But I'm in the process of moving across to the US platform, of course, still owned by IG. But just to show you what we did there. So we bought 2 of the 70 calls. Nice. And then sold 3 times as many of the 81s.
Okay, and this trade's been on for how long, Rich? A few days now or something? Or?
Yeah, just before numbers. So I think I put it on Friday, because I think Friday was the last day you could put new positions on UK Tasty. So you can see it's turned out to be an absolute belter. This structure cost 18 cents. 18 cents, and it's now worth, well, what have we got? We got 4.90 minus 12, so minus 36. It's now worth $4.50. Having paid 18 cents for it. So it's been an absolute beauty.
Well, having been very aware and having used your example of brand awareness when you look to pivot to the wrong things. Now Nike's gone back to, I think it was you said about how they've got some high profile athletes back on the board, running shoes performance. That made me look at a stock that I was speaking to James about in the summer on running. Which is a very visible brand, and so I've drawn a nice little kind of rectangle for zones of interest here. So, I mean, from in the summer he and I were talking, it was a kind of 55, but now expectations are for a poor third quarter. So forward EPS is decent.
So Hawk has had their bad one, and now it's moving on to
forward EPS has come down thanks to the magic of AI. That's come down quite drastically from analysts for the third quarter. Forward earnings for next year is still good because it's that particular brand where 40 plus executives are happy to wear them with a suit, so they have the disposable income. In fact, one of our viewers said he was on a flight in Asia and everyone had on running shoes on. So it's not about to go to much further down, I think. But again, if it stays in that box that I've drawn, that's a good level it's holding in. Nike and them are sort of competitors for a visible brand. I think, especially because on not. I mean, I have Hokas and they're great, but if you wear them with a pair of jeans, they're quite leery and they're quite quite noticeable.
Not like these bad boys.
Not like those, but and there we go. See, supporting his own
wide
trade.
shot in there. Come on, get that wide shot in, guys.
There we go. So yeah, it's
look at those beauties.
Rich is also showing off the
That's
fact
a good hamstring stretch as well.
Rich is actually showing off the fact he can get his legs still above desk height. So that's going to be the measure. Once a month, we'll look at the market level and then how Rich can get his leg up. But yeah, so things like on, and so it is. You can make money from trend following when you get the trend right. When things are broken and they make sense to you.
That's right. Yeah.
And you can apply this common sense yourself. You don't have to look at balance sheets. You don't have to look deep down into the accounts of a company. When you see and you walk into a shop, what are people buying?
Especially, in the consumer world. That's
consumers.
When I started off in retail, it was
charrette, right? It's absolutely true. So yeah, interesting.
I think someone needs to do some yoga, producer Phil.
Exactly.
So, yes, we do. What a nice studio setup we've got. It is absolutely wonderful, isn't it? Andrew McKelvey, thank you for that. Yes, you can lock in your profit. So if you just want to have a look back on that screen there. So the structure was selling those puts. So if you go back to our deep dive class on options, our beginners class, I sold puts to get premium in, to then spend on the 70 calls, but that still left me paying, probably $2. So I also sold a lot. You see, selling 9 of those 81 calls. That was me saying, there's no way they're going to be that good. They're not going to be up 18%. But you can, to answer your question, Andrew, you can take profit. So I bought back all of the puts after the numbers. Yesterday, I then sold one of the 70 calls because the stock got up to $76. So I managed to sell that for $6, but $6 I think it was, on the open yesterday. And then last night, I closed some of the calls as well. Just while we're on.
So you are actually looking at that very quickly for the viewers out there. Do you normally advocate for people who may be newer to this to basically take things off in the same ratio as you put them on?
Well, that's definitely the Sosnoff rule. Right. And while we're mentioning Tom, we haven't addressed this on the programme this week. So last Thursday, as I was in Germany, Tom did, of course, come on Tasty and say his goodbyes. So Tom's been a big part of this show. He hired me in the first place. So I've definitely got to thank him for that. But he's also been in this studio and we've done the tours. Many of you guys came to London. So Tom is or has left tastylive. The show must go on, as they say. Yep. So Tony Batista is still there every night, and he's joined by his son Nick. So Nicky Batista is now trying to get into those big shoes.
Absolutely.
That Soz leaves behind. But yeah, massive thanks to Tom, because of course he's built this incredible system and he's built tastylive, and it is his decision for this show to have taken place. So I've certainly got a lot to thank him for, and he is a hero of mine as well. It's really sad actually, because I prepare for this show at 8:30, 9 o'clock into the US close each night. So it was always just nice to have him on in the background.
Yeah,
here is moaning, and him and Bat having the banter. So I'm very much going to miss that, but we still got the Bats. So yeah, the show must go on. We've also got some sad news this week about we're losing somebody that's been a big part of this show in the morning, and that is it's sad news. But of course, people go on to bigger things.
Bigger and better things, that's right.
And that is Scotty. Scotty Byrne has just been poached from us for a wonderful job. I'm not going to mention who it's with, of course, because it's a big secret. But Scotty Byrne off back into full-time employment at the age of 72. Unbelievable.
Absolutely. See, ageism does not exist.
So Scotty, this might be one of our best and
Well,
last.
let's make sure it's one of the best then. Yeah.
So, huge thanks for coming in and helping us out, especially when I was
listen,
on
it's
holiday.
been, as I've said to everybody on the show, it's been great to have the support from everybody here and from everyone watching, and to just basically retest yourself in a different environment.
Yeah, completely different.
Because that's the thing, as we know, right? You work for a big bank, and as you say, there's change, but generally the truck rumbles on.
Yeah.
It's when you have to come out of that big structure, and as you say, having to cope with things like this, not dissimilar, right?
I think that's it actually, because we're the viewers will be very sad. We're very sad, but you and I have worked together since 2004. We've seen numerous new iterations of Credit Suisse.
Yeah.
And was there somebody on the desk that left that you were?
Yeah, I think when you just, I think it can also be when, as you know yourself, when you've started off, when a business is relatively new. I mean, you started at Credit Suisse when it was still absorbing all the Barclays people, and especially after 9/11 and those changes, and you grew into a good franchise.
Week,
absolutely.
Big layoffs then.
And then you grow the franchise, and a financial crisis, the market resets. You go to Brevin, you grow again. There's always these regrettable moves, and there's a couple of, and it can sometimes be someone you work with, it can be a good mentor, it can be, and you just have to try to take the good things you've learned from them,
that's it,
try to make them better with some of your own flavour. And it sounds like this new setup for Tasty with some new blood as well is always going to be interesting to look, and the show obviously will go on.
It's nice just to take that kind of time, obviously Beth, everybody
of course
in Tasty and obviously this show as well, really sad to see Sauce go, as the viewers are. I know there was a lot of viewers' comments, sending him the best wishes. So we also send you our best wishes.
Thank you very much. Yeah, thank you. What I'll be trying to, there's some lovely mentions on the comments. I'm going to try to put as much of my things I want to put on the Discord now while I'm available to, because I still don't know the capacity in which I'm going to be able to operate.
Probably not, I would say.
Probably not.
I'd say we probably want to kick him off the Discord.
But I might, but maybe I might have to go on as the Scarlet Pimpernel. So, yeah, exactly. I'm off already, apparently. I've been removed. So I think I would.
Are you joining MI5?
Yeah, absolutely. I still don't know a start date yet or anything, so I want to try to get on a couple more times. But again, thanks everybody. I will try to put as much as I can out there between now and the start date, and then I guess we'll just kind of see how it pans out. And who knows, in my new guise, I may one day appear back on the...
I bloody hope not. A few clues there as to where Scotty going, but we won't comment it.
Absolutely.
Brilliant. Right, it is 7:53. We are going to take a couple of minutes break, and we'll be back with you. We got the pre-market indications, and we'll go through our ideas into non-farms Friday. No, it's not, is it?
Well, the BLS did come out yesterday and said they are going to publish.
It is non-farms.
They came out last night and said they're going to publish. Whether it's going to be the full suite, because I know the last couple of days I've had no data, but it was out on a site I use, Financial Juice. I just happened to be on there. I get notifications from them. So the BLS did say, I mean, I'm sure in the break we could maybe look at the BLS website.
Because I tell you what, CNBC didn't have that this morning. They said there's no jobs numbers today.
Well, so again, we are going to fact check that. This is why
Scotty gets the big job and the big bucks. We'll see you in 2 minutes. We'll be back.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris CJ Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. We're back, you knuckleheads. Right, you want to get stuck into a Greg's this morning. Scotty,
Well,
you
as Andrew says, I have walked past the Greg's recruitment office a few times, but obviously haven't had a few too many sausage rolls over the years at Credit Suisse. But funny that Andrew should mention Greg's, because we were talking about this. They had a very good update, or a surprisingly good update for the market the other day, and it is starting to form. If I just bring up the proper chart, it's starting to form a bit of a base. Now, you did see the jump higher on that update. Again, it's had a bit of a reversal, but we are back above these moving averages, which is interesting. But also, just while I jump out of this and into here, the Times is also very nice little segue there from the Times. Thank you. Is this now a good time to invest in Greg? So I know a few of the people from looking at the Discord, speaking to people, I know that's one that we look at. Again, things like strategy for somewhere like a Greg's, there's probably not a ton of wriggle room.
I think that was my worst trade of the year, being long that.
But it's one of these things where everyone loves it, though. It's hard not to buy something everyone loves. I don't know of anyone who goes into Greg's and goes, I'm never going there again.
True. Yeah, even the vegans.
Yeah, exactly. And it's just one of those ones. And look, it could be interesting. And maybe someone did make the point. It was actually Ange, I think, said we've had such a good summer. You don't generally walk past a Greg's when it's June or July, when the sun's shining, and go, oh, what a sausage roll.
Yeah.
But when now it's rainy, the weather's turning 350 for like a sausage and bacon roll and a coffee.
Well, it's true. Look at that monstrous thing I had from Pret this morning. Scotty and I met each other in Pret this morning, unplanned. And I normally have a croissant, something like that, but I went for that filthy toasted ham and cheese croissant.
Yeah.
Which is, heart attack.
Yeah, and now all of a sudden you're starting to crave darkness, rain, water. Bell?
Grab that bell, Scotty. Right, we are right on the 8 a.m. It's the opening of the London Stock Exchange after. It's a big week. It's been a big week. 1.5% we're up on the FTSE this week. New highs, new highs. Scotty, have you captured some of that?
Blue skies, blue skies. I've been very obstinate. I'm struggling. I need to listen to the podcast a bit more because I'm just...
Sounds like you need to listen to Kate Murphy.
Yeah, well, yeah, absolutely, yeah. Another stellar month. She's in Cape Town at the moment, slumming it in Stellenbosch at wine farms and so on. So the life of a nautical trader. But she did send us a couple of... It was while you were away. She sent us a couple of videos of the waves from her crossing.
That's yes,
and it was making me just feel a bit wobbly just looking at them. But yeah, look.
Right, what stock prices are making you feel wobbly this morning then, Scotty?
Well, it's a nice little cyclical move again that we've seen after some new highs. Asia was a bit more mixed, but again, US, I mean, these aren't the same drivers. We don't have AI data centers, but that kind of lower for longer. And as we were talking about some of the stuff again in the Times, which we can touch upon, about where some of the things that Rees might focus on, as soon as you're speaking to Bill a bit later, he does like to, I think he described himself in a newsletter the other day as an optimistic pessimist. So, you know, FTSE at highs, the UK economy facing stocks are doing okay.
Let's go through them. So for those of you that are just listening, brushing your teeth in the background, and you want to hear the moves. NatWest up 1.1%, Barclays up 1%, and HSBC up 85. So some strength in the banks. The banks leading the way in the FTSE this morning.
Rolls-Royce still forging on. Obviously, power. That's another one of Bill's themes. Power, right, for the data centers.
Pow.
So things like Rolls-Royce, obviously that's going to be involved in some of that with things like their modular reactors. You got Glencore as well. That's always a good cyclical play to let you know what the market thinks about how the world outside of the world outside of London is looking.
What about the losers, Scotty? Weatherspoons. What is that? Just a
what is that?
That looks like a widespread there.
Yeah,
right? It clearly is down. Haven't seen as Weatherspoons have numbers. Have a look at that. I'll have a look at GSK down 70 basis points. Diageo down 0.5%. That was one I picked up yesterday on the rumours that Trump was going to get rid of the tariffs on Scotch. So I bought some Diageo going into the close yesterday. That doesn't look so smart this morning. Then we've got some of the defensive there. Unilever down 30 bips, Bats down 20, and that's pretty
right. Let's
much
have a
it.
quick look at Weatherspoons. I did see Trump's now looking at taking a stake in US rare earths as well. That was on CNBC.
Oh, is that? Well, that's what we're waiting on Pensana. So that
right.
could be
Okay.
big.
Yeah. So they were up, I think, 6% yesterday. So yeah.
Right, we have had numbers in Weatherspoons. Here they are, reported
Around your profit.
10% rise in adjusted pre-tax, helped by resilient demand, those £4.50 pints in the middle of Fulham. They have been doing well. However, the stock is not doing well this morning.
Let's have a little look at
Cost increases such as those in the budget will undoubtedly add to underlying inflation. Tim Martin, a big voice in the space, isn't he? It expects a reasonable outcome for its current financial year, though rising government-imposed costs, including energy, could affect performance.
Well, that also ties in as well. We see we are Segway City this morning because that also ties in with that piece that we saw on the front page of the business section in the Times for the Tesco boss.
Yes,
Reeves, enough is enough. So that's also I can jump to that as well if that helps.
Yeah,
just to say, so you can see that the people who are running the companies that matter to kind of everyday living, if you like, which obviously Wetherspoons is a part of, as is Tesco's. So we can see
Your everyday living.
Well, I mean, look, you can see that this is very clear that business is making representation to Reeves that these things are really hurting. Look, it's no secret to people. It is inflationary as well. So the taxes that she's imposing also have the double whammy effect, the fact that they're inflationary.
Yeah. Let's just have a look at, so your advertising clearly is bats there. If we switch to mine's IG. So I've got gambling and you've got smoking.
Well, the last time I was on with Ange, I brought the Times up and it had an advert for The Rock's new movie, The Smashing Machine. So obviously AI looks at me and thinks, crikey, is that The Rock? Let's get some advertising up for there. Yeah, I really need to address my sidebar advertising. It's better than some of the ones that's come up. So thankful for, thankful for small mercies. Yeah, exactly. And the lateness of the budget as well, he makes the point, which is end of October. As opposed to early October. So yeah, listen, there's clear pressure from business.
Yeah.
And again, maybe this is something you can mention to Bill a little bit later on when he comes on the show, because he does like to make the point that, look, there are things she could do. It might not be as bad as everyone thinks. Anyway,
right.
European going on in L'Europe.
Stellantis. It's killing me. Big move yesterday, bigger than Porsche. I doubled up in Porsche, so I'm now long Porsche. I also bought the European autos because European autos obviously have lagged a lot. So we are, what do you call it when you're bigger on one side of the pair trade than the other?
Ratioed.
Yeah,
Ratioed.
is there a
lopsided?
Lopsided. I get that kind of.
Yeah.
So Stellantis hurting me. I'm sorry, but I'll go against that. Because the cars are still shit. We're talking about Renault, Peugeot.
Well, so Ange and I did touch upon this when you were away. So you could actually see, again, it was only a single snapshot for a particular day, but you could definitely see, because Europe's been underperforming, which again, you might be speaking to Joachim about, or Joe, as you like to call him, about where you've definitely seen things like the cyclicals and the industrials were underperforming and the cars were outperforming, which could be a bit of portfolio unwinding.
Yeah.
If you're running along short to go back into the US. Mm-hmm. So, I mean, there's surely nothing fundamental in the cars that are saying to us.
Well, no, there was a good SAR number.
Oh, I beg your pardon, I missed that. SAR number.
So good SAR number for Stellantis. So that set it off to the races yesterday.
Fair.
One swallow does not make a Peugeot a good car.
No, it doesn't.
Right. Puma down 1%. Oh, this is not good. This is a bad morning for my my positions. And we've got ASML down there, 50 basis points. Yeah.
InBev, again, I guess if Wetherspoons are poor, InBev's maybe a little bit down in sympathy with...
that's why Diageo's down. Thank you, Scotty.
Yeah.
Nicely done.
And what about, was that France we just had, or Germany? Sorry, I'm being silly.
That was Europe.
Oh, that was Europe. Oh, you've got Europe, right. Okay, Ange has France and Germany, so...
Exactly, yeah.
I'd just like to look at the...
No, I see Europe as one.
Yeah, absolutely, yeah. Interestingly, decent rally in Wetherspoons, is that Fresnillo, there we go, silver again, just jet powering that. Schroeder's having a good move this morning, actually. It's quite interesting, isn't it?
It is, yeah. Also, Anglos really has kicked on there. Of course, that merger news came when the stock was £24.20. That was your big opportunity to buy those in the opening auction. £24.20, now 28. Just 3 weeks later.
Amazing.
Incredible, isn't it? So Anglo's having a really good time of it. BHP also going higher this morning. That was £19.90 at the time. So if we look at it, Anglo's has moved 15% and BHP's moved 3%. So that just shows you, the difference in the alpha there. Rio's has had a good few weeks as well. And yeah, a strong FTSE this morning. Where does that leave us overall in the indices? Yeah, up 30 basis points.
Yeah, that kind
across
of makes
the board,
sense.
really.
Yeah, Hong Kong's been a bit weak, but again, we've got China closed for Golden Week till the 9th. So that's and that's had such a run on tech. That's probably just a little bit of profit taking, perhaps.
Yeah.
We did see Bank of Japan's Ueda speaking this morning. being supportive of the economy, even though things are weak. So that ties in with this new Prime Minister who's going to come in, who's supposed to be fiscally supportive of the economy. So the Nikkei just keeps breaking out as well. So it's just, it's almost like whack-a-mole for markets going up. There's just seems to be a real lack of...
That was you trying to say Joe's name again.
yeah.
Right.
No,
Currency.
can't say that more than twice in a day.
134.30. It's holding its own there. 134.30 on cable. Dollar yen 147.65. Now, Luke Moore has promised us by the end of the week we're going to have Eurodollar back on this page. So it's not there just yet, but we
Has he broken it or something?
Very much look forward. Eurodollar just fell off the major FX page as gold fell off the commodities page. So on commodities, we got silver up again, 4,729. We've got copper above 500. So remember, it fell from grace because of the tariffs from 540 down to 440. And now it's making ground back up, of course, because of that tragic accident in Freeport McMoran's mine. But that takes a lot of copper production out till 2027. Copper, now one of my favourite commodities.
I mean, I must admit that was one of the most interesting things on the podcast, because I love stats about certain things when they were talking about how long it takes a mine to come from shoveling the ground to production. And what was it, 20?
Yeah, between 17 and 20 years.
17 and 20 years. It's, really makes you realise, doesn't it?
Yeah.
Right, my most uncomfortable part of the show's coming up, which is guess the chart thing. Of all the things I'm bad at, this is by far the worst. So I expect our viewers to jump in super quick to that when we're ready. But shall we go to guess the chart? Oh, just very quickly. So this is something that you can obtain from the Chicago Fed. It's the National Financial Conditions Index, and basically, the more negative these numbers are, the looser the financial conditions. So, as you can see, they've been in a very steady since the Trump tantrum in April. Financial conditions continue to get looser in the US, which is driven by several factors. I won't go through.
So, do you mind just zooming in on that a little bit? So the red is risk.
Yes. The red is risk, blue is credit, green is leverage, and then you can effectively, if you're at zero, it's as tight as it can be.
And zero's at the top.
Zero's at the top. So it's an inverted number. I mean, it's only a 1 year chart. Again,
right, so the bigger the blocks are,
the more liquidity there is in the system. And this is...
So the more positive for markets.
More positive for markets, basically. Yeah. And this is a question. So everyone's been saying about QT, what it's doing, and in real terms, basically, because high yield credit is tight, yields are tight, the lending market is loose. So where you're getting things, and there's some of this argument about, right, the Fed's cut rates, but the 10-year yield has gone down, or effectively the bond price has gone down and the yield's gone up.
Right, okay.
So that doesn't necessarily translate, because the Fed fund rates is a driver of the economy and the immediate spot economy and financial conditions and lending, whereas the 10-year, as it implies, is what we put into risk models. And this is why the likes of you and I look at the 10-year yield going, well, that's not coming down. Why is the market going up?
Yeah.
And so this is why you get, so this is why, again, when we're looking at the data, when you just see the dollar, the easiest thing to look at for the financial conditions is the dollar. So you saw last week had that rally, markets came down, they're just moving in step. So if anyone wants to look at big picture stuff, at the moment, because we're back to a weaker dollar again, yields are coming a bit tighter, but in the background, financial conditions are still very loose. And look at these things Trump's are doing. I mean, the US government taking stakes in Intel, rare earths, lithium. I mean, it's like a capitalist's fantasy land of a president, isn't it? It's like...
And our chairman from the podcast saying, loosening when there is plenty of liquidity already around. What could possibly go wrong?
Well, this is the point, and there is, and it's the same thing if you talk to Bill, follow the money. I mean, these things are, again, the semiconductor index just new. I mean, it's not just making new highs every day like the S&P, it's making new highs like this, and money has to go Money has to go somewhere. It's like a flower bed with cracks in it. If you pour water on it after a hot summer, it just goes.
So after the break, we're going to talk about what we would do in our experience. What happens next? Scotty, of course, been trading for 57 years. Myself for slightly less. What happens next when we see liquidity becoming more abundant and also cutting interest rates, and the wealth effect also contributing to people's feel-good factor as well.
Yes.
So we're going to look at that in Fast Markets in 2.
Once he was a hurdler, chasing down the line. Then he found the markets, futures on his mind. From London's banks to mining trades, Rich built his story through the deals he made. She was on the front lines, breaking daily news, from Bloomberg desk to the Reader's views. Anchoring the headlines, stories bold and true. Angeline carried the markets through 2 different roads, 1 destiny. Now every morning the world can see. On Trade Live with IG, the family's in place. Rich and Ang set the tone, every chart, every race. With the crew and the guests and the laughter they bring. It's markets, it's magic, it's everything. Piers with his passion for US tech. Axel's trade of the week keeps us all in check. Chris with analysis sharp and fast. John with commodities built to last. Simon with gold that glitters and gleams, while the YouTube crowd fills up the streams.
Welcome back. Let's have a quick look at what the chart was, because it's got us stumped. Neil Brewster saying Barrett's, is that right?
Barrett?
It is. Barrett Redrow.
Look at that.
Well done. So I think was Boise is BTRW, is that Barrett Redrow? It must be, yeah.
Yeah, Barrett Redrow.
Well done, Boise. I think that's the first time Boise's ever won anything.
I know. I think you see, it's those smaller house builders. I generally look at things like a Barclay Group for always. I don't know why, but
Yeah.
that is quite interesting. Again, in the house builders, because we were looking at this. You and I have looked at this, and Ange, where they were. A couple of the viewers asked in the comments what we thought of house builders. That's when I was on with Esau about 3 weeks ago.
Yep.
Do you remember? And they were basing, but that doesn't mean that they were going to necessarily move higher. But again, if interest rates are going to creep down globally, you know, if Reeves doesn't do, again, this is Bill Blaine being the optimistic pessimist. You know, maybe it's just interesting to look at. Boston Frank, Elon owns 14% of Tesla. Well, in that case, he's probably got the casting vote on his salary package as well, doesn't he?
Right, let's go into what we just touched on before the break then, Scotty. So we are getting more liquidity. So more abundant liquidity conditions allow people, and I saw risk was on there. There's more money sloshing around, first of all. And then the price action of certain things at the moment makes people want to put on risk. Now, not to spoil the podcast, but just to give you a little taste of the podcast, we went through every single one of our assets, right? And I'll give you a clue, not a single one did we say we wanted to reduce.
Well, yeah, because you would be swimming against the tide. So there's
Swimming against the tide. This market action gives perhaps false confidence, the ability to make as much profit, 14% in gold in 1 month, right? It's easy. It's never been easier to make money in financial markets because you just buy something and everything goes up. When people start moving into small caps, as we've done, you know, we've had an incredible focus in defense holdings. We've seen Pensana go higher. Every stock mentioned, suddenly it's up 20, 30%. That can lead people into a false sense of security about what lies ahead.
I think it's very much about what you're trading, because I think the difference with the podcast is you're allocating your capital into asset segments or into asset classes.
Yeah.
And the danger is when you're trading every day, when you start, it's one of those things. It's fine to be cautious, but the minute you're not cautious, because we were actually having this conversation on the Discord, when you're in these markets, when they feel like you can just buy anything and you're going to go up. But anyway, if you're not in that phase of the market, so you're not in like this, you should spend as much time on your stop losses and what could go wrong, because no one's got a crystal ball. But as long as you spend enough time on your stop losses, when you're trading single stocks, as long as you're rational, because you can look, these stocks are going up every day. You don't just have to sit and hold. You can trade them every day. You can be flat at the end of the day. You can go back in. When you start feeling those FOMO sensations that you're getting, then that's the danger signal as a single stock trader. When you're just coming in every day, and as soon as the market opens, you want to jump in like a greyhound out the traps. That's when it's a bit of a concern. But I did
without too much thought behind it.
That's correct.
You might hear an idea on here.
Yeah, just
And you might
exactly.
just go, oh yeah, well they've given us Defence Holdings, Pensana, Smarter Web when it was doing its good thing. I'm going to buy it without even knowing what it does.
Always do your own research. What are you buying? You're buying hype. And look, hype is not the same as explosive earnings growth. Companies in this environment, in the AI hype train, if you want to be glib, can have explosive earnings. When I mean, how can you have a stock like Intel that's just been like nothing for months? And this makes sort of older heads like us go, it's all gone mad, right?
Was it 65% in 2 months?
Yeah, exactly. So again, when you've got the US government taking stakes in businesses, but again, why shouldn't they? Because you think across Europe and in the UK, the government used to own a green shoe, as they called it, a strategic holding of key assets.
Yeah, but that's different, is it? I mean, if we want to take a look
different.
at the Nasdaq right
Yeah.
now, this is going back to the good old days when we were coming out of financial crisis. Now, the path that we're on there, you don't want something to go wrong, do you?
No.
Because as you can see, when it turns, when it has a pullback, and this was COVID. Look at that. The whole world goes into shutdown, and look at the little blip it is on the screen. And you have a look at, where we are on that trajectory now. That is risk, that is liquidity, and leverage.
Yes.
Right? Now, to me, that is why I'm out. Because when we go...
And that's fine. That's fine, right? Because the point about it is, it's like we were saying about how you go on, and the thing is, look, psychology of trading, I think, can be largely broken down into your approach to every day, because you can't have a psychology around how you trade, but if your processes are sound, that will then help to keep your psychology sound, because it's when you feel like you're losing control of yourself, when you're getting that FOMO, like you just want to come in and buy everything every day, that's when you need to walk away for a week. And listen, if you're in, if you're out, I'm underweight, certainly relative to the last couple of years, because I don't understand, although again, it depends when you get it depends where you get your data from, because I saw a piece from Goldman, I think it's either Goldman or Morgan, saying when you get a Fed cutting rates, now again, the anecdotal thing is, Fed cuts rates, it's the start of a recession, market sells off, because that's the easiest, it's the first thing that you stick into AI, that's the first answer it spits out. Goldman actually said, I'm sure it was Goldman or Morgan, one of the two, where they basically said, when the Fed has cut rates, but there's no recession, the S&P's gone up 50% in 2 years. But people always focus on when the Fed are cutting rates because there's a recession.
Yeah.
So listen, and some of the US commentators out there, there's a guy, Ed Yardini, who's like the art cash-in, but he's obviously still around.
He's God.
Yeah, he's God, right? And he just said, he thinks we're still in the roaring 2020s. You see S&P at 10,000. Because he's just saying forward earnings growth and how the market is taking stuff is...
But he's bearish at the moment.
He's cautious at the moment.
Yeah.
So to be fair to him, throughout the sell-off of the Trump stuff, he wrote recession risk up to 62%. Now they're back to sub 30%. and he's very much in the phrase of, again,
Yeah.
these guys have seen it all before.
Exactly. We've seen it all before. We've seen this many times, and this, look, I'm not chart. I don't believe in charts, but this channel that we were in of last year, right? That's as simple as you can get. You take the peaks and you run through. Now, in my simple, idiot, dumb emphasis on simple, producer Phil says, like that will go down to the bottom of the range, right?
Well,
but that is 10%. And a 10%
Yes.
pullback in the NASDAQ now is going to blow people up.
Well, I think the key thing on that there is that, and that's what some of the chartists like to call a channel check, isn't it? Right? When it breaks out, as you saw there, look a bit further back in your line,
Yeah.
right above the T and tech.
Every
When it
single
breaks
time
out,
it's come back.
That's that irrationality. It's come out, right? It could happen in a month's time.
Yeah.
Because the point about it is we can't sort of look to possibly time this. But yeah, look, there are definite ways. And again, though, this is where you still have to have a plan where you say, okay, am I too leveraged? Am I uncomfortable? If you're in a position where you come in every day and you're sleeping 8 hours at night and you're comfortable, fair play, you're in.
Well, of course you'd be comfortable because we're going through all-time highs in every single asset class out there.
Correct.
Bitcoin, we're almost there. Gold, we are there. Certainly, NASDAQ, Nikkei, FTSE, DAX is getting back up there. It's impossible not to make money in these markets. I want you to do an exercise at home, your current positions.
Yeah.
I want you to say, right, something happens over the weekend that is completely unimaginable, right? A black swan is not something we're going to forecast here now.
But you can't, it's impossible, yeah.
I want you to model us down at this level, right? Now that is 10% down on the NASDAQ. What happens to your portfolio on Monday morning if the NASDAQ's down 10, that's Nvidia down 20, Palantir down 25,
Yeah, exactly.
the FTSE down 7, and what would happen to your risk limits, your margins, to your pensions? Write that number down and see if you're happy with it.
Absolutely. Maybe we've got time. Just go back to the comments very quickly because I saw a question from the Pelican, who I met last week at the London
you
Prop
did.
Trading Show on the Saturday. Really quick. Earnings for certain companies are going to be a market mover, but the tech is backloaded because we had Nvidia only like a month ago. So things like the bank's earnings, I mean, when you're the likes of a JP Morgan, Morgan Stanley, Goldman Sachs, where you're in every part of the economy, they're going to be blowout.
Yeah.
But they'll probably, if you look, they haven't been leading. They'll most probably be good on the day. I think the thing to look at from the bank's earnings is things like loan quality and the credit quality, any rise in bad loans, that kind of stuff. That will just
Almost as if 800,000 of the population wouldn't be getting paid for the next month.
Well,
that kind of situation.
Well, this is it. Yeah, I mean, this is it, right? Those are the things you want to look at when you're looking at the banks. Stay away from the headline numbers because in the US banks, they just make your head spin. It's like 7 years worth of Credit Suisse numbers in a quarter. So, yeah, definitely. And as Pelican says, yeah, exactly. Set your stops tight and just carry on trading. But again, just ask yourself the worst thing you could picture happening can happen.
Yeah.
If you're comfortable with it,
And it
then you've got to
happens
go
very
ahead
quickly.
because everyone's had a great run thanks to this channel, largely. So you don't want to spoil it. Anyway,
Have we, where Arthur Fox Haig, where has that comment come from? Because that is, there it is. Friar Tuck has come out with, clearly has worked on a trading floor. There are old traders and there's bold traders, but there are very few old, bold traders.
That's correct. That's one of the, and we've got an old bald trader on the show right now. So,
Good stuff. Scott, you sticking around for 9 a.m.?
100%.
For the all sessions?
wouldn't miss it for the world.
Good stuff. Right. Joe coming in to give his words of wisdom in about 93 seconds.
Wow.
Stick with us. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets,
letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hello, trader friends. Welcome back to the show. And we have the one and only Joachim.
Hello, how are you?
Very good indeed. I'm pleased that I'm not having to accidentally wake you up somewhere across the world, but I assume that's going to happen very shortly in 3 weeks.
Yes, second half of October, I will not be here. I will be somewhere in Asia, depending on the date that you're looking at.
Although this time around, I'm going to be doing my research alongside Joachim in Asia, and I've preempted him because I'm flying the day before you.
Yeah, but I go to nicer places than you do.
Oh, I get to do all the fun stuff, which you don't say is not required. I actually like going to visit all the companies that I
Yeah, no, it's not for me.
am investing in or I'm thinking about investing in. Joachim's very much a show me the balance sheet.
Exactly. Show me the numbers and then we can talk.
Yeah.
I don't need to be dazzled by nice cars, even though I have to say being a car analyst or a luxury good analyst has its perks.
Speaking of perks, you have picked, I've asked Joachim every time he comes over I want it to be as useful as possible for our friends here. And so I want to look at some of these trade theories that you're looking at. One of them involves a Finnish company.
Oh, yeah.
Kone Elevators, right?
Correct. Elevators, escalators, but mostly elevators. They have been in the headlines over the last 10 days, 2 weeks, because they have decided to buy TK Elevators. So TK Elevators is ThyssenKrupp's, the German elevator company, spin-off that was taken private in 2020, I think, or 2021, and they just bought it from private equity. And what is really interesting about them are two things. First of all, Kone has been struggling for a while because amongst the 4 big elevator companies, which is Kone, TK Elevators, Schindler, and the American Otis, it historically had the biggest exposure to China and Asia, and as you can imagine, that didn't go too well. Now, with the TK elevator purchase, they are moving more in the direction of the US, and they're becoming the world's largest elevator company. And as a result, they have found newfound momentum in their share price and just broken out a couple of formations and resistance. So it is a really interesting momentum play now for the last 1 or 2 weeks. And I think as the biggest one in the industry, which is now basically 3 major players, it is one to watch. The alternative, if you are more pro-European like I am, and think that the US commercial real estate space is not going to be doing too well, where Kone is putting a lot of emphasis on, is Schindler. Swiss Schindler.
Right, I'm going to put
Much
up
more
a
European focused.
rebase chart of Kone versus Schindler. I came in early to try and get this sorted for both of you. Here we are. Look at the stock performance there. Kone is the blue. Schindler is the red, and currently we're seeing that Schindler is outperforming. This is rebased, might I remind you, versus Kone. So this, largely ties in with your theory.
Yeah, Schindler is a boring company in a very good sense. It is really kind
Amazing
of like
history,
fantastic history, steady Eddie, really high quality product. They have long moved out of China and Asia for their high-tech elevators because they basically said, well, look, Siemens sold exactly 2 magnetic levitation trains to China and then not a single more. Guess what happened then? And so Schindler basically said, nah, that's not for us. We focus on our European markets. We focus on the aftermarket, where there is actually much more money to be made in servicing and maintaining these elevators. And now Kone is more the turnaround story with this refocusing from Asia towards the US.
Just to show how exciting it is, these circles that I mix in, I have been told, and you can tell me this is true or not, but I've been told that if you have the Ferrari of lifts and elevators, has to be a Schindler.
Yes.
Apparently.
Yes. That is absolutely true, I think, in terms of the highest quality product out there in the market, especially when it comes to high-tech elevators, is Schindler. Having said that, in order to give you a balanced view, the only time I was trapped in a stuck elevator, it was a Schindler.
Also, interestingly, just pointing out, friends, if you're not aware, we've both worked in Finland before. Kone, you know what it means, right?
No, I don't.
It means, in Finnish, it means machine.
Oh.
Yeah.
Interesting.
And I had many conversations with many colleagues quite often because it's also seen as a forward-leading indicator. If there's a lot of building, you tend to want to see a lot of copper demand, right? Copper, building, plumbing, everything. And then once you've built the foundations and the civil bit, now you have to build the buildings. And you need, for a lot of growth, you need lifts and elevators. So that's where Kone comes in. So many times at Bloomberg and Reuters as well, I get this person shouting across the floor going, hey, anyone know how you pronounce Kone? Or cone, everyone. And I say Kone, and then they then shout across, how do you know? And I go, I've been there. Weird question. But anyway, yeah, so it means machine. And Kone helps, their tagline is it helps millions of people gain mobility.
Yeah.
Speaking of mobility, another one that you like, very excited about this, because I always get very excited when it's a space that I don't know much about. Prysmian versus
Nexans. Yes.
Is that how I say it? Nexans? Without the S?
Without the S. So Nexans, French company. Prysmian, despite the name Italian. They are 2 of the 3 large cable guys. Not the movie and nothing to do with cable TV, but both of these companies. The third one, by the way, is Danish NKT, which is much smaller than those 2. Those 3 companies are the leading providers for modern cables, both in the communication space, as well as in the energy, renewable energy space. So I love them all three. I think all three of them are great opportunities for the next 2 to 3 years for a variety of reasons. The best performing over the last 1 to 2 years has been Prysmian, because Prysmian is much bigger in the data center space. So they provide a lot of the power and telecom signal cables for data centers. Okay, so it is a little bit like the NVIDIA of cables in a sense, because they really surf on that trend. The problem with that is that because of that, they also are a little bit more of a one-trick pony. Of course, they have a diversified portfolio, but the share price is very much a bet on AI. Nexans, French, has gone through a couple of acquisitions and restructurings, which is why it forms that bottom there. And it is involved in data center cables, but it is, unlike Prysmian, has a bigger weight towards power and electric grid connections, which means in particular offshore wind farms, solar and onshore wind, and connecting it to the electric grid, which is particularly important because they also have business in Germany, where as of 1st of October, the first money is flowing in Germany's big infrastructure package, the famous 500 billion euros that need to be spent over the next 10 to 12 years. The German government wants to spend about 28 billion euros in the fourth quarter of this year alone, and then 60 billion in the next 5 years each year on infrastructure investments. And besides roads, bridges, and other transport infrastructure, the energy transition, which means connecting wind and solar to the electric grid, is the second biggest recipient of money there.
Nice. So Prysmian, more pure play, Nexans, more broad
diversified,
play.
Broad play. And if you want to go in the opposite direction and just have a almost pure play on wind, solar, then NKT is your name, because they are almost specializing in these kind of grid connections for renewable energy.
Interesting, interesting. And looking at Nexans, for example, here, the share price, it's got a period of consolidation since around the 18th of August there. You know, what do you want to see out of Nexans before it suggests that we could potentially be seeing another leg higher? Let's take a look at the weekly and monthly chart there.
Well, personally, I do like what you just showed us on the daily chart, where it is bouncing off some nice support lines. Yes, we've had over the last month or two some consolidation, just basically like we had in Europe in general. So they're not kind of underperforming, they're just following the general European trend.
Right.
And I think we will see a bounce. And that, by the way, is why Nexans is not overbought, while Prysmian, if you go for the 14-day RSI, is overbought. And so it's got more room to bounce. It is more kind of, I would say, sensibly priced at this point in time. And as I said, the real trigger comes when we get some first quarterly results with kind of the impact of the German infrastructure spending, whether that has lifted earnings, and some more information about how the newly restructured business is gaining traction. And so far, they're executing really well.
Okay, so a good one to keep an eye on. Just drawing the area of interest for you from a technician's point of view, and it is looking like it is consolidating, waiting and see over there. This is the weekly chart, friends, and as you can see, it's come off, and it looked like it was trying to get to the high seen 28th of October 2024. Looking at the monthly view as well, similar picture there, but a good one to keep an eye on to see whether there's a breakout in the daily chart before moving on to the two other durations. Another one that is moving, but one that we talk about quite often. I'm very curious as how you're going to link something else that I love with the US economy. It's a very odd message from Joachim this morning, and I was like, I'm seeing US economy in the same line as a Ferrari.
Well, no, I see Ferrari as a key beneficiary of the US economy, which sounds weird.
It does sound weird. Especially, I'm going to try and bring up a
There you go,
picture.
with the ugliest Ferrari of the last 10 years. So I have this theory that the uglier Ferrari gets, the more they sell.
I'm glad you're talking about the car, not the person stood in front
The
of
person in front of it looks pretty as always. The cars are, I mean, the cars used to be incredibly beautiful. I think the last few models were just hysterically ugly. But then again, what do I care? I can't afford one anyway. In any case,
And there's no
here's the
point
thing.
driving one in London anyway.
well, exactly. I mean, it's like it could be worse. I was once working on a project in Saudi Arabia, and the CEO of the bank that I was working with said, well, yeah, I used to have a Ferrari, but I no longer have it because there's so many potholes here in Saudi Arabia on the roads that you're better off with an SUV anyway.
Oh, really?
Yeah.
I'm surprised. I mean, I've not been to Saudi, but with that much oil, you would think they would have, roads made from heaven with all that free time.
That's Dubai for you. That's not Saudi Arabia.
Oh.
Yeah. Or at least it wasn't 10 years ago. In any case, basically what I found was I read a nice statistic a week ago about the US economy where somebody claimed that the top 20% of US households by income are responsible for more than 50% of all consumer spending in the US. And I was like, that sounds scary and weird at the same time. So I checked. It's not top 20%, it's top 30%. But
Oh,
the
wow.
top third of US households by income are responsible for 51% of US consumer spending. And that is important because we obviously face in the US an increasing price hit from tariffs. And Ferrari's share price was hit by that as well, because Ferrari obviously makes all its cars in Italy and has to pay 25% tariffs in order to ship it to the US. So there was a bit of a worry that Ferrari, just like Porsche, might be kind of under pressure in the US, which is their biggest market. But it turns out that if you look at it, well, yes, most people will face higher costs and will actually have less money to spend next year. If you do a distributional analysis, the lower your income, the more you will lose next year. So the lowest 10%, the poorest 10% households will lose an estimated 6.5% of their income next year compared to this year, thanks to US budgets and the tariffs. While the top 10% will gain 2%. Because first of all, they don't care that much about the tariffs because that's not really a big part of their spending. And number two, they just got a really nice tax break. And so the end result is if you just look at US data, on average, consumer income drops by about 1.5% next year. The US economy is about 2/3 to 70% consumption.
Yes,
so that
US
would mean,
consumer.
correct. That would mean 1% lower GDP growth, and it would really be a worry for the US economy to get close to recession. But if you then weigh it by how much people are actually spending, well, what you will see in retail sales data, GDP data, is actually just a 0.5% drop in consumer spending, and hence an 0.3% drop in GDP, because the economy effectively, the overall data shows what the top 20% are doing, not the rest.
And this is why, friends, we always talk about, data, changing data, to keep an eye on the reasons why seasonality and why Chris Beecham is going to be very cross with this. He's very into seasonality, but why that could change during different years, right? We're in Trump 2.0, plus the fact that you've heard me say more than once on the show that if you look at data, the number of rich people in the US is increasing.
It's ridiculous. Yeah.
It's increasing.
Really like the Gilded Age of the Rockefellers and Carnegies. Yeah.
Yeah. And what this does is it skews data.
Correct.
Right? And you're seeing that actually when the US economy should look like it's less resilient, it's looking super resilient, because guess what? Rich people are buying more, and that's being reflected on the data itself.
I mean, if you want to know why the US economy didn't go into recession in 22, 23 when we got the cost of living shock, while Europe and the UK did, Well, here's the answer. The Federal Reserve of Boston did exactly that analysis and showed that the top 20% just kept on spending because they rely on the stock market and they never really felt the cost of living damage. And that's why the US was so resilient. It wasn't resilient. Most people were in recession, but the data didn't show it.
It didn't show it. And also, it didn't show and reflect that the top, high net worths, all they did during that time was either they didn't feel it or like, well, I'll just liquidate another, 50K of Alphabet shares that I put in 20 years ago.
Exactly.
Which of course isn't 50K anymore. Lots of questions on the floor. Shrimp Fred, do you want to read out that question? I'm testing out new lenses, Joachim, new lenses, and I'm still getting used to them. So, Shrimp Fred, what is the US 20 percentile level?
It's about $150,000 in household income, roughly.
Right. And also, we talk about this very often too, because we go to the US to work quite a bit. And I've got family all across except for the middle bit. It's a land of contrasts. It just feels like it's several countries.
It is. It is. I mean,
Mushed into one.
I don't want to be too political, but I once did a little exercise because there's the Human Development Index, which is, unlike GDP, measures things like educational attainment, life expectancy, healthcare outcomes, etc. And I split it up between states that voted for Donald Trump and states that voted for, that was in 2016, Hillary Clinton, but it's the same result now for Kamala Harris. And the Human Development Index for blue states is the highest in the world. That's rivaling Netherlands, Sweden, etc. The Human Development Index of red states is about the same as Russia.
Wow.
Yeah.
There are also, even if you look on the ground, and this is why the whole skinny pin, skinny pill thing will continue to flourish. There is a real contrast between what one type of American can afford to put on the dining table and the other type of American. So I'm just going to leave it at that. Yes, Shrimp Fred saying polarization next year or more polarization.
I was like, can it get more polarized without breaking out into civil war? I don't know.
Yeah, it'd be interesting. Bring your popcorn. That's what I say. Monkey Man, as government worker, are government workers in the top 20%? My lenses are clearly not working, the new lenses.
Quite frankly, my sister-in-law is a very highly paid government worker in Alaska, and I can tell you she's nowhere near the top 20%.
Yes, she works at forests or something, right?
She works for the Department of Agriculture, and she's in charge of the national forests in southwestern Alaska, so basically around Juneau, where the capital is. The forests there and the Glacier National Park, not Glacier National, Mendenhall Glacier. So we always joke that she's in charge of an ice cube. That's
like a dream job.
Oh, yeah. I mean, apart from having to deal with 400 employees that you're responsible for, is a really cool job. Yeah.
Right. We've got just under 3 minutes of Joachim. Send your questions in if you want them answered. I'm going to have this cheeky look and a wink at you as I say. So we're now 3rd of October.
Yes. German Independence Day. Reunification Day. Go on.
Jugga.
We won't have a single German on the call today.
Well, Jugga, we've got Jugga today, don't we?
Is he on?
I think he is on.
Okay.
Yes. So I'm wondering whether he's listening because normally he's very active on the chat. But we haven't seen this correction, and if anything, we've seen this squeeze up.
I told you 2 weeks ago.
You did,
it's
but
gone.
I'm just double checking.
I was wrong. Thanks for pointing that out yet again.
It's my job. No, but jokes aside, are we going to see any delayed, pushback, or
so
are we past that point?
So my hypothesis right now is that when it comes to UK and Europe, we are now facing a period where European GDP growth, macroeconomic growth, is slowly accelerating into 2026. So from that perspective, in the UK and Europe, we're actually on really good foundations for a stock market rally throughout 2026. In the US, I am much more skeptical. I do think that the US economy will slow down and inflation will pick up. Nothing out of the ordinary here. Everybody expects that. And normally that would be bad for US stocks. But we're also in a world where the Fed is under massive political pressure to cut interest rates. And quite frankly, it is that sugar rush from Fed rate cuts. As long as those rate cuts are ongoing, I think the US market will not have a major correction, because the rate cuts support AI investments, they support growth stocks, which lead the market. I think that will change into a value leadership in 2026, but for now, no reason to kind of believe that there's a major trend reversal. But be aware that I think the US market is facing a sugar high that eventually will break.
There we have it, sugar high that just be careful that eventually will break. We have to make sure that Joachim gets back to the office in time, so we're going to have to love him and leave him here, although I would love to have him here for longer. Any more questions, slam the like and subscribe button or email ask@ig.com. It does come to me and I will check them and I'll get it in front of Joachim if you have more questions for him. Thank you so much for coming on.
Well, thank you as always for having me.
Right, stay right there because we are going to have plenty more coming up, including Bill Blaine, and also we're going to have Rich back with me to do that. Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris CJ Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. We're back. Scotty and I have just been out for our coffees.
Yes, they're very fancy coffees for a Friday. They're great for us today. Sorry for anyone who bought them.
For those of you that have been to the IG office, there is a Greg's right outside, and it's because this used to be the old trading pit.
The old life market, yes, that's right. Yeah, that's right. Yeah, it's always had some kind of takeaway. There actually used to be a Burley's sandwich shop in the station. And Burley's used to have this very, very expensive hot special every day. But what they used to do was, in order to beat the queues, they used to make a load of them and leave them under the grill so they'd stay warm.
Nice.
Well, that's true, but a lot of the time it had cheese in. So if you had one of the first ones made, it's a bit gloopy. So the life traders used to go in and order some and say, none of them Valerie Singletons, which is an old Blue Peter saying, here's one I made earlier. I want it fresh, none of those Valerie Singletons. All right, anyway, right.
Very good. Well, yeah, so I had to drag Scotty past Greg's. He tried to go in. I was going to take a picture for you all.
Almost tears making me walk past there. There was almost tears. Right, so
yeah, we're still going to ring the bell, even though we're going from 24-hour trading into all sessions.
nothing wrong with tradition.
I'm going to ring the bell.
Right.
this
You
morning.
go ahead. You go
So,
ahead. Who muted it?
bull-
Who muted it, by the way?
Who do you think?
Is this popular demand?
Well, no, he did try to mute the whole thing.
Right.
But I took the tape off the inside, even
Yeah.
with his.
Shame.
So, but we can still give it, if you put it at the right angle.
You can still give it some. You can still give it some. Okay, right.
Right, so what are we looking at this morning? Well, we're looking at Boeing. So Boeing, there was a news report in CNBC yesterday that the 777 was going to be delayed, and it could cost billions. So yeah, we're going to be looking at Boeing on this open.
There we go. That's a proper wake up. There's not a lot of love for that in the gallery.
Right, so Intel up and away 30. It's approaching 38 bucks.
That's brilliant.
This was
I
at
just think it's
19.
brilliant.
It's up 100%.
I just think it's brilliant. Absolutely brilliant. Well, it's actually it's interesting to see. There is some decent movers here. We were talking about Tesla earlier on. That's trying to make an early fight back. So again, bearish engulfing. Definitely worth watching next couple of days for that. If you like playing trends, AMD, no surprises there. Broadcom, no surprise. I was going around. We were looking at there's a great thing on the CNBC website. If anybody is on that, for a pretty cheap subscription, you get what's called the Playbook daily notes, which is after hours. So big stock stories for Friday. There's a couple of things here which are definitely worth
Let's check.
worth looking at. We'll do an F11. There we go. So there's a bit about energy. Again, as you can see, oil's just still on that downtrend that we did mention that a couple of times on the Discord as oversupply comes back onto that. Occidental and Berkshire. I'm sure you've probably mentioned that on the show yesterday. Occidental getting bought by Berkshire, but there was.
What? They've increased their.
But yeah,
It's not getting bid for.
Sorry, increased their holding.
Oh my lord! Whoa, you give me a heart attack. I've just sold my Occidental.
A couple of things that we were.
They're still increasing their stake, are they?
Yeah, a couple of things that we were talking about is the private equity names like the KKRs, Apollo, Blackstone, TPG, Blue Owl, more than 10% because there's concerns over default risk in the portfolios. Again, we talked about this just before we had that rally in the dollar. Market came off a little bit. So again, better to be lucky than good.
Yeah.
But again, the concerns over rising default rates are the factors driving investors to pull back from alternative asset managers, which I think is just, again, it's not going to be a canary in the coal mine because AI is driving these moves. Interesting. On CNBC's Power Lunch, Wedbush's Dan Ive said Lyft could be acquired in the next 6 to 9 months.
Well, I have wondered, what the future of Lyft is, because of course you've got Tesla, you've got Uber. So where does it sit? So that's interesting. Who do they think it could be acquired by?
Yeah, well, it just says it's an M&A target for big tech. I mean, these big tech firms just want to sort of own the world, right? So they want the whole circular economy of the power, the data centers, the chip production. And look, I'm sure there are opportunities that we don't necessarily sit down and think about to look at where these things can slot in.
Yeah, it would certainly make sense. I see Uber's maybe even a target for one of the big names, like Apple, for example.
Yeah.
Apple buying Uber would.
Well, and again, as you see here, let's click on the story. He mentioned several other possible targets as the AI-related M&A.
Oh yeah, let's
floodgates
see,
open. So let's have a look.
All this cash around. Who else?
Let's have a little look. No horrible adverts. That's good. We'll carry on as we are. So there we go. Oops. Oh look, there we go. Should have guessed. There's always an advert.
Advertising another.
So prime M&A targets C3.ai and SanDisk among the prime M&A targets. Apple and IBM are likely to be the acquirers because they're looking to play catch up in the AI race. So again, maybe that's something to do a bit of research on yourselves.
This takes me back. So 2011, Scotty and I worked on the same team for the first time under Rodrigo Rodriguez.
That's right.
And so we used to have a morning meeting every single morning and strategize. And Scotty came up with this idea to put on an M&A basket because, of course, post 2010, all the companies' balance sheets were in very different positions. And we put together an M&A basket, didn't we? Top targets, just
right.
exactly like this thing.
Yeah, that's right.
And how many of them got bid for?
I think none of them.
None of them. As long as we held the basket, we sold the basket, and bloody 3 of them got bid for.
I know. The thing about it is you can always, it's when you play an M&A, time is your killer because you're short time.
Exactly.
And the thing is, it's one of these things where sometimes if you discuss things in a group, bounce off each other, it's great. But when you all convince each other it's a good idea, then you almost need a fourth person to go, what are you talking about?
What you got them in there for?
Yeah, exactly.
Just because Dan Ives has said it. So our monkey, our I think #1 viewer on the show, Monkey Man, is asking us to have a drink of rum. So are you up for it, Scotty?
Well, I mean, you could stick some in your coffee. That might be quite nice.
Who says I don't already have?
Well, I wouldn't possibly like to speculate.
Sorry, he's saying look at rum. Okay, so rum is, of course, Rumble, the video sharing platform. These have, this is a weekly chart. So I think we can go on a daily, it'll get us a little bit more. Yeah, there we go. So Rumble has just been rumbling along the lows, but where it was before the numbers back in deck. I would imagine, not to put you on the spot, Scotty, but it's not one that we really trade too much, is it?
It's just not a stock that's in the hotspot of stories at the moment. And this is the thing, is you're generally reactive to unless you're super disciplined and you've identified a core of stocks. I mean, some people have stocks that they love trading, right? Yeah, for whatever reason, because they love the volatility or lack of it or whatever it is. But yeah, I mean, the problem is video sharing. If I heard my kids start talking about this as a platform, that would probably make me look at it.
Yes, definitely.
But yeah, they don't. I mean, I've never heard this mentioned. Again, with things like how the streaming services have kind of peaked. I mean, you saw Netflix was one of the kind of leading out performers on the way out of the Trump tantrum. Now that's kind of run out of steam. So yeah, I would have to hear from somebody or read something that would make me want to look at
exactly
this space and make me look at it.
So Monkey, sorry we can't give you too much more in there, but certainly if you want to drop me your thoughts later, drop me an email. I'll watch out for it.
Yeah. Lastly for Steve, this
there it is.
Just to clarify,
it's up 13% pre-market as it's done a deal with Perplexity. There you go. I knew there would be a reason.
Video sharing has done a deal with Perplexity. I'm going to have to look at that. I love Perplexity. Well, actually, Steve Davis, just to clarify, before everyone really gets really tearful when the subscriptions collapse, because they should double, because I'm not finishing today. This is hopefully not my last day. But yeah, Steve, I think a little tip is, I think a little tip is, my favourite tip is always do your own research. Because only then, because you've only got yourself to answer to. And
I like that. Yeah.
Always do your own research, because this is a brilliant show, and I'm not just saying it, the Discord's great, and it's one of these things. If I wasn't moving on into something else, I would get more involved with the Discord, I would share more stuff. But whatever your version of your own research entails, but just the main thing is just understand what you're trading.
Do you prescribe to the trade small, trade often? Or when you've got those big convictions?
So yes, but again, there's always flexibility around, okay, what you start trading as an interesting idea, that can then become something that grows more, like the Nike short, right? So it's what, a year, well, it's at least months ago you start talking about this. So then that can then become, so you can just look and readjust. So you can even close a trade and go back to it. So that's just, so simply because you trade in one thing, that doesn't mean it's the end of it. So there are some of the people at the trading school. So if you speak to D&D or the traders at D&D, as one of the co-founders there, will sometimes have 9 trades going on, because he just likes longer term swing trading with small trades with stops. So he doesn't just start off with a position and run, because then you lose track of what your stop loss should be and your methodology once things run away with you. So you can, So you just figure out a way to trade. That's what I would probably stick with. Your own research and just understand what you're trading. But yeah, that Perplexity deal, I think that's really interesting. I mean, I love Perplexity. For single stocks, for a free platform, it's brilliant.
There we go. So video sharing platform and cloud service provider today announced a strategic partnership with Perplexity.
Pro, it's the Perplexity Pro. So I'm on the standard, so you can upgrade. So I think what they do is, I can understand where they might start making videos of some of the analysis they do on Pro. I've never looked at Pro, so that's quite interesting. I'm going to definitely take a look at that because I say, love Perplexity. So I'll be really interested to see how they share with that. Right.
Thank you, Monkey, as always, providing value for us. Very much appreciated.
Andrew, never. No. In your own research, always rely on yourself. No one else to do it for you.
We've got our coffee. I think it's time for some porridge.
Nicely done. And again, as I said to Rich, Bill does have a YouTube daily that he puts out. It's a little bit later on after the show, so it can segue quite nicely. So you can finish on the show here. We switch off and we go do our thing, and then his videos come out, and they're a very great thing to have in the background because he basically runs through the premise of his note daily. So like this channel, definitely worth a like and subscribe. And if you like a nice kind of, Scottish accent like Rich's, it's a very nice...
Well, he's got a little bit finer one than me, Bill Blaine. A true Edinburgh accent.
He definitely does. But yeah, again, to watch or listen, it's a great thing to have on, especially if you're looking at charts, because he just talks about a few different things. So yeah,
good.
Definitely like it.
Right, there it is. Morning porridge coming up after the break. We've got Bill Blaine, Scotty Byrne. Have a fantastic weekend.
Definitely will.
Anything big?
No, pretty quiet. My wife's at an all-day brunch, or like a brunch thing tomorrow, so I'll see her on Sunday. Yeah, my wife. So I'll see her on Sunday at some point.
Good stuff. Right, Bill Blaine coming up. Scotty Byrne, thank you.
Cheers.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
To the show, and we're doing an old school remix of Rich and myself and another Scottish man, Bill Blaine.
It's almost a Scottish sandwich, but we've got it the wrong way around.
Yeah.
How are you?
I am just fine and dandy. Looking forward to the weekend. Unfortunately, it's going to be a howling gale, so no sailing this weekend.
Speaking of howling, I understand a very close associate of yours has been trading AI stocks with you and is with you in the office.
Indeed, I have my small dog dinner jacket. Well, no, he won't come up. He's decided. I don't think he put his makeup on this morning, so he's just sitting underneath the desk. But the pair of us we've been looking at the markets this week, and one of our big topics, of course, is AI. a fascinating market, and we should chat about that. The other thing I think we need to have a little bit to think about is we've got a US government shutdown. What did the stock markets do? They rallied.
Nothing.
I think there's all kinds of way of looking at that. And then, as Scotty very kindly says, I have started doing videos, which are up on the Morning Porridge website. I would love everyone to open them, listen to them, say how fantastic they are, even though I know they're kind of still developing. But it'd be great to get some following on them. Aside from that, what do you want to talk about, boys and girls?
The whole shutdown thing, we were talking about this many weeks ago, and I was asked by plenty of people here, is there any cause for concern, and what's going to happen? And I crunched some numbers on the Bloomberg and showed them, what happened the last time in, I believe it's 2018, 30 odd days, right?
December, yeah.
Yeah.
35 days. Market up 10%.
So
indeed,
there was other things going on there, of course, and there was a lot of volatility in the middle of it.
Yeah, I think if you're going to look at the US shutdown, you got to put it into the context of what's happening in America just now and the new Trump administration. You could almost argue that this is a godsend for Trump, because his core argument, or one of the core arguments of the MAGA crowd and the dark alignment of the tech barons, is that the government needs to be reduced in size.
Yep.
And we've seen with Doge, the Department of Government Efficiency, that that's very, very hard to achieve. But what you do here, and what he's already doing, instead of furloughing state workers, he's sacking them. And I see that the guy who was co-running Doge with Musk, I can't remember what his name is, Indian fellow, he's saying that 75% of government employees should simply be sacked, and if we then later discover there's a use for them, we can hire them back. So that's one aspect to look at it. The reason the market likes it is because they want to see government spending brought under control. It's as simple as that. And they are thinking, okay, that's a positive. And if we end up seeing something of a slowdown as a result, that will simply speed up the Fed in easing rates. Yeah. And again, that's market positive. So yeah, you can argue it's cynical, you can argue it's kind of cruel, but it's going to boost the markets. However, there is another much longer term thing going on in the States, and that's the whole way that democracy hasn't been working. I'm sorry if this all sounds terribly political when we should be talking about markets. But as we all know, it's politicians that set confidence in the economy. They're the guys who set the rules and regulations that make it work.
Yeah, it's all about optics here.
Yeah, well, it is. But if you think about what's really happening in the States, you've got this enormous polarization and gridlock on Capitol Hill. It's almost impossible to reach any kind of decision, as we've seen with the shutdown. And more to the point, if you get down to any spending discussion, it just becomes what the Americans call pork barreling, where it's trading off each other, who gets money spent in their state and who doesn't, and they then reach an agreement. It's a terrible way to do government. And there is a growing sense on the far libertarian right. And these are not the people who are storming the Capitol or complaining about immigrants. These are the thinkers on the far right. And there's one called Curtis Yavin, and his recommendation is forget democracy completely. The democracy we have today is one that is run by the establishment, and by that he means the media, the academics, and the hard left. I mean, I would probably point out to him who owns X, and that most of the US media is actually owned by the right wing. But let's not quibble. Yavin's approach is that America needs a king. They need a monarchy. But that would be a modern monarchy, and it would replace the current presidency. And he points out that at the moment, well, you can actually see this happening, because on November the 5th, we've got a very important decision in the Supreme Court.
No.
And the Supreme Court will be opining on whether the tariffs are legal. Now,
this is a huge day. Now, this is the entire presidency comes down to this decision.
Yeah. Now, if they say the tariffs are illegal, the consequences will be chaotic. So my own guess is they'll find a fudge. But it is also very possible that they decide that the tariffs are legal. Now, what that does would then create massive uncertainty. Now, we all know from school days, because we were forced to study the American Constitution, because at that point, when I was young, Europe still liked America.
Oh, Bill, we lost you.
I think we've lost your
Yeah.
sound, Bill. Just as you were touching on the Ryder Cup result as well.
And we lost you there. Maybe try and dial back. Right, we'll try and get Bill back in a moment.
Bill's dog has
Severed the cable with
Yeah.
its gnashers.
So it is what we're talking about. November 5th is, of course, this decision by the Supreme Court. Are the tariffs legal? If they say they're not, then it's the Supreme Court, right? That's the end of it. And hundreds of billions of dollars are going to have to give back to companies. And what happens then? Well, the bond market will collapse because, of course, it's $500 billion that's been promised by Besant back into the US budget. The shutdown completely changes. And
Here's Johnny.
Here he is.
Here he
And
is.
You suddenly have a US budget that's massively out of whack. And the bond market will be absolutely chaotic. So,
This
as
is
Bill
why-
says,
yeah.
it might be a bit of a fudge.
Yeah, and to keep
So
the
where
things
did you
moving.
lose me, boys and girls?
Ah,
Yeah. So you just announced November the 5th, and of course, if the decision goes against them, then it's utter chaos.
I can't.
All right,
I
so-
think it'll be a
so-
fudge because they can't possibly risk, destabilization or any more chaos. So they'll find a
Well,
way of doing it,
let's-
getting it through.
Let's have a wee think about what it might do, because if they decide that it's okay for Trump to make these tariffs in response to the emergency in trading, because that's how he's defining it, then effectively it's going to undermine the three parts, the checks and balances between the executive, the legislature, which is Congress, and the Supreme Court, which is the judiciary. And that is the basis of the Constitution. And that's also why we've got such gridlock now in the US, because when the legislator cannot agree anything, you can't get anything passed. And that's the problem we just discussed. Now, the argument that the libertarian monarchists are making now is that if we just put a CEO with a decent board behind them, you could make the country work, just like a good company. And it was absolutely fascinating. Now, I'm going to mention a media rival, a crowd you guys have never heard of, called the BBC. And they have a great program on Radio 4 called The Moral Maze. And this guy, Yavin, was on it. And, he was fascinating in the same way that Hungry Tiger is fascinating, discussing how this thing would actually work. Now, one of the other people who were on that show, she said something I thought was absolutely fascinating. Here we are, the public have been monetized for private wealth. They're literally cooking the planet for the benefit of shareholders, and we're putting the blame on democracy.
Yeah, 100%.
I mean, it is an incredible world we live in. But you can see the argument that you could cut through all the problems in the States by putting a decent CEO in charge. Now, the really interesting thing from my perspective is how will this affect markets? Now, there's no reason to actually think that it would actually change markets that much. So you would think, because if you have a pro-libertarian government who encourage capitalism and roll back some of the regulations and the rules, it'll make it easier for companies. But what we've seen over the last 300 odd years for democracy, parliamentary democracy has become the norm, is that we get a balance. And that balance, I think, is most vividly illustrated by that regulations will tend to protect consumers, whereas deregulation will tend to benefit shareholders. And the trick is where you find the balance in the middle. And the other thing that really worries me, of course, is how benign would an American monarchy be? And I would simply point out the Trumps. We've got Donald Trump, we've got his family, we've now got his son-in-law, Jared Kushner, fully involved in the Gaza project. And many people are saying, look at the conflict of interest. These guys are doing political capitalism, making themselves as rich as possible. Now, I have no comment on that. It's not my job to say if that is right or wrong. That is the job of the Supreme Court and the American Constitution. That's what it's there for. It's up to the American Constitution to tell Trump if he's doing bad or he's doing good. We don't need, people like me opinionating on the state kleptocracy taking over the US. Not that I want to sound biased, of course.
But Bill, sorry. So let's bring this back to the S&P. What does the S&P 500 do into that that decision? What does the bond market do into that decision, and what's the consequences of the result either way?
Two very different things, and you and I both know the answer to the first part of that question, Rich. The Fortune 500 is going to absolutely soar, because CEOs are going to see the opportunity for deregulation and a libertarian economy that is going to boost stocks. Fantastic. What is the bond market going to do is a far more interesting question. If you can start to control deficits and you have a much stronger guidance on the economy and you stop spending, that's a positive. But bond markets are not unthoughtful. They're going to work out that this is going to create pushback and it's going to create massive inequality. And I think one of the things that really worries the bond market are demonstrations that are planned for this weekend. America against King Donald, or something like that it's called.
Right.
Now, it will be dismissed as radical left-wing nonsense by the media. Of course it will. But the fact is, if you end up creating a society where you see wealth inequality continuing to widen, that will create critical ramifications. Now, in my morning porridge this morning, I talk about an absolutely fantastic series of books by a very famous English author called Terry Pratchett. Unfortunately, he died early a few years ago, but his books were about the Discworld. And one of the characters there is Lord Vetinari, who is the patrician, the leader, the ruler, unquestioned ruler of the main city in the story. And he's an absolute believer in democracy. One man, one vote. He is that man, and he has that vote. And the way that he runs the economy and the whole government is perfect. It's the way that a monarchy would work. Of course, it's only fiction. I very much doubt that Donald Trump would be anything like him.
Bill, listening to what you're saying, this just suggests a further squeeze up for stocks. What would you say to those on our chat?
But this is only going to happen in the very long term.
Yeah, that's not the call. The call is November the 5th.
Immediately, what we've got to be looking at. And the reason I bring it up is because the government shutdown and the way that the stock market sees that is a positive. And remember, the bond market has not reacted. It's essentially unchanged. But certainly stocks see the slowdown as not a problem, and in fact, possibly even as positive, especially as no matter what CEOs say about the costs on the American people of a shutdown, they're going to be delighted if it means lower bills.
So if you were hesitant to jump back into stocks, especially the techs, the AI type stocks, would you wait then after the 5th, then jump back in again? I know you've got a lot to say about AI as well, and what if the entire world is wrong about this revolution? I have differing views on this because I am watching a different data set and it shows jobs that are being displaced by technology. And I think that, it's here to stay. What's your view?
Oh, look, Angeline, I completely agree with you. AI is here. It is going to change the world. It's the most important technological revolution, paradigm shift since the age of steam and industrialization. It's massive, but it's how it actually happens is what we should be worried about as stock market watchers and market commentators. Now, at the moment, the consensus is going completely along with the American vision of AI, and that started off with these large language models. And these are the things where you need enormous amounts of computing power, you need the most modern chips, therefore you need to build the data centers. And that creates overwhelming demand for electricity, so you have a whole economy that is doing that. At the end of the day, they are going to change the way we do things, but there is an alternative. And that alternative, and we'll call these large language models closed weight. That's the way you talk about them in AI, because these are models that guys like ChatGPT develop themselves, and everything is internalized. We don't know how they work, hence closed weight. We don't know how they weight the various parts and the parameters of the algos that drive them. The alternative is what we call open weight, where you can actually take these things and you see how them work. And they use small language models, and you can put them into your own business. Now, the great thing there about the small language models is you control the data that's going into them. You retain data sovereignty. And the interesting thing is that Meta's approach to AI is much more along the open AI, but it's very much what the Chinese are doing. The Chinese are building these open systems, and more to the point, they're giving them away effectively for free. So the world is starting to use them. Now, in America, I read this morning that somebody has just invested another 40 trillion billion gazillion dollars in building yet more data centers, which means we will need yet more nuclear power stations to fire them all up. And in China, they're just getting on with using older chips and building systems that do things almost as well. Now, there's a great story that I want, YouTube won't be old enough to remember this, but back in the 1970s and 80s, we had the invention of a thing called the video recorder, which I know nobody under the age of 40 has ever heard about. But there were two different technologies that worked with the video recorder. One was called VHS,
The
and
old
it was
Betamax.
it was
versus
and the other was Betamax. Gosh, you're older than you look, Rich.
That's
All right,
what
and
work he's got
Betamax.
done, you see.
The Betamax paradox is that something that is better will not sell if the alternative is cheaper and almost as good. And that's what happened. We ended up with VHS as the video standard. Now, we have these
Not to mention a certain industry that supported VHS at the time. But that's another,
Well,
that's another
Yeah.
conversation.
Yeah. But the thing is, the whole market thus far has been betting on these closed weight large language models like ChatGPT, betting on NVIDIA chips as the only way of powering them, betting on Oracle to build the data centers that Sam Altman is building, financed by SoftBank, and using Microsoft and Amazon to do the cloud service along with them. What if the way that AI actually changes the world is that companies decide, I don't want to give my data up to ChatGPT. I want to keep my data and I want to use it in my own systems to power my own business using this open model that DeepSeek or Alibaba can provide me. And what I'm hearing out of Silicon Valley is that the new or the latest round of AI startups are all coming with these open weight systems, and many of them are actually using the Chinese ones, the Alibaba one, Qwen 3. And that's what's going to be the future. So
who's the
all
biggest
this
loser
money-
from that then, Bill?
Well, the loser is going to be the Betamax, which is the closed weight systems, which already have absorbed trillions in infrastructure spending. And I reckon the ultimate loser is going to be NVIDIA.
Let's have a look at, whilst Bill's talking, let's throw my chart up, because this is what makes a data center in
Brilliant.
2025. Bill knows how to rock my boat when you talk about chips and technology and power. And that is why I'm looking at investing in power, your Oklos. Look at how this is set up. So you've got your cooling towers made by the Evapcos, Baltimore. You've got your chillers, you've got your switch gears. Reason why I am bringing that up first is, look at who's making the picks and shovels here. Obviously, we know about the NVIDIAs already. That's in the networking space to the bottom right-hand corner. But you also have the people making the generators, your Caterpillars, your Rolls-Royce, Kate Murphy. So pay attention to this, the power distribution. Schneider, you heard about the cabling. We're going to need a huge amount of cabling, which is why I had Joachim on for you talking about Prismium and Naxen. I hope I didn't say that the wrong way. Naxen?
Oh, terribly, terribly impressive, Angeline, my dear. But
but now irrelevant. If you listen to what Bill's saying,
yes, but
he's saying that
we don't need it.
That
you don't
you
need the
don't
power.
need it. I'll tell you what.
Why don't
the
we need the power?
Chinese
We
He
do
just
are
told
doing
you
it
you don't
at
need
the
the power
price.
because it's a different system that would be
Yeah,
used.
and
We're
the
still
Chinese
going
are
to
doing
need
at the
it
price.
for all the generation of computing that is going to come off of those free LLMs.
No, it's a much more efficient system.
No,
gonna
the
be that
LLMs
efficient.
are not free.
I think you're
The
still going to
LLMs are
need.
trying to set them up, Angeline, the large language model, the closed weight systems, the GPTs, the Claudes, and I can't remember what the other one's called suddenly. They are going to set themselves up as monopoly suppliers. That's their aim. Is the open weight systems are the ones that I suspect the world's going to use, which are less infrastructure intensive. And they're the ones that the Chinese are already leading the development was. So I think you're quite right to point out just how linked in the global economy of power and
I agree that
infrastructure
Nvidia is going to lose out.
But I reckon it's happening in China.
But I think the whole power side of things, so aside from this, you're still going to need a huge amount of power. Don't forget, we don't have solar and we don't have, this is the wider EV space as well. I've just bought an EV, as you know.
Well, yeah.
I have to say it's not
Well,
as...
this is where this argument gets fascinating because, as we all know, Trump slammed shut the door on Biden's renewable power. And he's focusing on drill, baby, drill. And just this week, he announced that he was going to free up coal mining. Now, the reason he's doing that is because he realizes that the generative capacity in the US is just not expanding at the kind of rate that we need to power up all these data centers.
Exactly.
But
you need a base.
then if you go the other side of the Pacific and you go into China, and China has been, is now the 96% or something of renewable energy. And they have also been building coal and gas-fired fossil power. Now they're set to power the current economy using fossil fuel, and they're going to use that renewable power to fuel the future. Now, just before I came on the show, I was listening to your fascinating discussion on Boeing, which is one of the stocks that I follow very, very closely. And I could talk for months about Boeing. If you think I'm boring about things like Trump and democracy and AI, don't get me started
You're never
in
boring,
aviation.
never boring.
But here's the thing. There are things like sustainable aviation fuel, which everyone has dismissed so far, because if you want to fly planes using fuel made from soya, you're going to have to cover the whole planet in soya, so it'll never work. But what you can do is use renewable energy to make hydrogen. And then if you spend money on building carbon capture technologies, you can create what we're now calling power to liquid, which will be used in aircraft. It will probably require further modernization of aircraft engines, but that is going to be the future of flight. And that is all going to happen in China because China's got the renewable power.
Yeah.
It ain't going to happen in the USA after Trump closed down renewable power.
Yeah.
So that's just another factor in the argument to think about.
Do you see the 777 announcement last night that it's going to be delayed? The analysts have already got something in their numbers for that delay. Do you think it's worse than expected?
It's been anticipated for a long time that was going to be delayed. But the good news, earlier this week, or was it last week, Boeing was allowed to build more aircraft. They passed the inspections by the FAA, so they'll actually start delivering more. Now, Boeing has 6,000 plus planes on order, and they cannot deliver them fast enough. The real problem I see with Boeing is because of all the problems of the last 10 years, since even after they launched the Boeing Max and then it crashed, they have spent all their money and they don't have the capital left to develop new aircraft. Now, this week, the stock took a bounce when they said they were finally about to start designing a new aircraft. And the only way that's going to be financed is with government aid. Now, I can definitely see that happening because Trump is always accusing Airbus of subsidizing the development of new aircraft here in Europe. At the moment, Airbus is ahead in developing the next iteration of global aviation. It will be 20% more fuel efficient. Boeing is going to play catch up. But Airbus and the Chinese, I think, have something going on because the Chinese have been trying to develop their own aircraft.
Have you managed to get on a COMAX? Have you managed to go on a COMAX,
I have never
Bill?
flown on a COMAC. I've never flown on a COMAC. I'm not entirely sure I want to fly on something that is basically
look
a
at the
1970s
reviews.
Trident.
Have a look.
But the thing is, they have scaled, the Chinese just this week started scaling back on COMAC. And I think that means they're coming to an agreement with buying the technology from Airbus. And effectively, China becomes part of the Airbus network. That's a hazard of a guess, but that's what I reckon is going on.
I don't think
Airbus is going to supply the Chinese market, the biggest aviation market in the world.
I don't think you're far wrong, Bill, because if you go to any Porsche showroom or dealership, I know you're looking for a car as well, just look and ask them to tell you how it's powered, especially the new SUVs. Underneath the Taycan is about 60-something BYD batteries, right? There's a lot of cross-pollination here on the power generation front for China and, you know, big brands like that.
I'm glad you mentioned cars because you and I have been talking about Chinese cars. I was very impressed by the Omoda 9, but my wife persuaded me, let's wait.
Yeah.
I went to see Porsche because the Cayenne was high on my list to replace. I have now lost faith in Range Rover. So the Cayenne was high on my list. But to be honest, I was maybe badly dressed. I was wearing a pair of shorts and a t-shirt. And the guy looked at me. Now, I was always taught, don't worry what the guy's wearing. Look at his glasses and look at his watch and look at his shoes.
Where are your glasses,
But this
Rich?
salesman took one look at me and thought, what are you doing in a Porsche showroom? Now, I'd driven up in my wife's battered old Fiat 500, and he's obviously thinking, who's this joker? And he says, sir, and he basically said to me, sir, can you afford this? I went, what kind of question is that? Oh, I have to ask the question because it's an FSA regulation. And I said, I don't think it is. Because I'm a
he asked
banker.
if you could afford.
Cheeky.
Yes, basically,
That's
I asked,
really
can I afford
cheeky.
this car? And I said, why are you asking that? He said, it's an FSA regulation.
That's
I said,
crazy.
bollocks.
It is
Absolute bollocks. The suffice of that, I didn't even bother taking a test drive in the Cayenne. I did like the other German cars, but I ended
I'm
up...
very disappointed here because you've got my pair trade on. So I'm short Stellantis, i.e. your wife's car, and I'm long Porsche at the moment. So I am going to get this guy sacked because I need you to be buying that
Go ahead and do it. I'll send you his email. I was
Bill,
I was actually black. I was black affronted, as they say, Richard. Black affronted by it.
It's disgrace.
Bill,
Anyway,
firstly, I'll go for
the
the
long and
Panamera.
short of it is I have gone Japanese.
In Asia, you don't sell to the person, you don't approach the person with the fancy glasses or the fancy watch. You approach the person with the flip-flops on because they're the ones, they've invested all their money. Who moved my cheese? The recent $100 billion deal promise between NVIDIA and OpenAI referenced 10 gigawatts of compute. To put that in perspective, the UK uses about 60 gigawatts of power on a wind turbine.
Yeah, so Bill, come on, let's go back to this. You just dropped the mic and you said, right, NVIDIA's done. It's got the wrong multiple on the wrong estimates going forward because China is going to be the VHS and NVIDIA and America is going to be the Betamax. So when does this happen?
And I don't think it's that bad for America because Americans are going to quickly adopt the open weight technologies. Effectively, Facebook's there already. I just think people are going to look and they're going to say, this is a company that expects to make billions.
What's the duration though, Bill? What's the duration?
Sorry?
What's the duration?
When does the market realise? Because the stock's at all-time highs.
I think this is long-term trade, but as you know, as soon as the market spots the long-term, it will start to do it. Here's me at a time when NVIDIA has climbed to 4.5 trillion net value, and I'm saying that's overweighted. That's far too expensive, because they are not, the world is not going to end up entirely based on AI that is driven by closed weight LLMs. There will be a role for them, there certainly will be, and I'm sure we'll all use them, but most companies are going to change themselves and become more modern by using systems that they can innovate themselves in their own software, and that means going for the open weight systems. And that means they can afford to use chips that are much cheaper and can be built by lots of other people, including the Chinese.
And less energy intensive, which is the whole problem.
Correct.
That are the Who Moved My
Yeah, but I
Cheese
wouldn't
just
worry
made
about
the comment.
I wouldn't worry about the amount of money we're spending in energy, because we will always find a use for cheap energy.
It's not necessarily the amount of money we're spending. It's what's the fallout, because you can't just click your fingers and produce that energy. AI needs the energy tomorrow, and it's going to take years to get anywhere near what we need. So what happens in the middle? We've got a vacuum there where everybody's going to have the demand for the AI, and we will not have the energy. So are we going to get blackouts? Or, what's
Oh, well, you're asking me to be a futurologist now. I'm just going to leave you with one thought. I think it was this week that AOL finally turned off their dial-up service. Now, 20 years ago, within living memory for all of us, we were all putting in AOL discs into our computers. We reckoned it was the most valuable company on the world. And you know what? Today, it doesn't exist.
Flying Scotsman 400 meter H at AOL.com. Still remember it.
Well, Bill, thank you so much for being with us. Always a pleasure having you on to throw ideas around. I hope our clients and friends have had a great time listening as well. For those of you wanting to put questions in, I know that you've sent me some, but we're running out of time. So send it to ask@ig.com and I'll get it in front of Bill. Also, don't forget to slam the like and subscribe and
give us a thumbs
Okay.
up. Bill,
Marvelous. And I
you
would
for
urge
finishing
you
off
all
the
to
week.
read The Morning Porridge, or at least view my videos and give me a sense of purpose and meaning in the morning. Thank you all very much. Speak to you next week. Bye-bye.
Cheers, Bill, and thank you to everybody there as well. That is us for the week. It's been a good week, Ange, hasn't it?
that's been amazing.
What was your highlight?
Lots of great guests. Joe on the Ferrari and Corny, the lift. Also, we had Michael Seen on again.
Yes.
Just great.
That's right. Of course, your first interview with Mike.
I checked for you. It's Sing.
Sing.
Yeah.
So yeah, it's been a great week. Thank you very much, everybody, for joining us. As I said, just take a look at your risk. That's what we were doing in The Art of Investing yesterday. That'll be with you at 4 p.m. if you want any more of my Scottish dulcet tones. That'll be with you 4 p.m. this afternoon on not this YouTube, but the IG YouTube, Art of Investing on Spotify and Apple Podcasts.
Long live and prosper.
are back. That's Mr. Mike Butler in Chicago. Glenn Freiberg is with him. I'm Ilya Spivak here in San Francisco. Glenn, am I pronouncing your last name correctly?
Freiberger. Yeah, it's phonetic.
There we go. There we go. There we go. Not good with the names.
That's all right. You can just
ask
call
me
me
who
G-Money.
the deputy governor of the BOJ is. I might actually have an answer for you, but real people names? That's not my department.
Freiberger with an A. That's what I say.
There
Need
it
a
is.
J.
That works.
How's it going, gentlemen?
Yeah. So the government's shut down. Market
Apparently,
actually,
yes.
Market actually sold off a little bit into the close. Interesting.
Yeah.
Glenn actually brought up some interesting data points earlier today related to how market shutdown could be bad for US dollar in the short term, not so bad for equity markets. It's interesting.
But of course,
this is sort of the essence of what we've been talking about this week, right? In anticipation of this thing going down, is do the markets actually care about any of this? And it seems like even at the onset, I mean, obviously going into this overnight, I mean, futures were down all night. So Europe didn't like it. Asia didn't like it. We had some pretty hairy wicks. I mean, if we look at the S&P here, we can see that overnight things were definitely a little spicy. So looking at sort of where we got the S&P at one point, S&P futures, ES, was down something like almost 1%, like maybe 0.9% from the close yesterday. But obviously, we are not doing that here. So U.S. markets seem to come in and think, yeah, this is nothing. This is fine. Is this just because we're expecting for all of the posturing to eventually give us an answer? I mean, I think Westwater had a great chart that he's been sharing all week that basically says the longest shutdown was the 30-plus days in 2018, and markets were up. So ostensibly, is the framework here then, well, if it's within 30 days-ish, then we've seen this movie before and it's not painful. So I'll see you in a month? Is that what this is?
I mean, I would take it one step further and say that even the last occurrence, 35 days, I mean, that was a long time. And so
Yes.
I wouldn't necessarily be looking at a month. I'd honestly be looking at next week. I think we knew that this was coming as far as economic data not getting non-farms this week. We got a number today from the private ADP.
Did we ever?
And we're pricing in now for pretty certain a cut in October and not needing another data point to confirm or deny that. I think everyone's comfortable with thinking that the Fed is comfortable with that. And so I would look to next week, just because in looking at the previous, 20 shutdowns, the median duration of it is 3 days, and the mean being, I think, around 8. And that's skewed heavily by the last occurrence.
By the 35, yeah.
And a couple others that lasted 2 weeks, roughly. And so I'm looking at next week just to see if this is one of those blips. Okay, we needed everyone to get on the same page, past whatever we were close to, or if there really are holdouts and we end up with a continuation package that isn't what people are expecting. That's the only thing I'm thinking of, not playing in the consensus right now.
Yeah. I mean, markets are drifting higher, volatility getting crushed. The prediction markets have this shutdown lasting 90% of the probability based on betting markets is at the very least October 6th to 9th. And then it's about a 30% chop between that week, the week after, or the October 15th or later selection. So 90% of bettors are saying it will last till the 6th.
So a little weekend retreat.
Yeah.
Get all your ducks in a row. Come with your answers on Monday.
Yeah. To Glenn's point, though, the CME FedWatch tool where we look to gauge probabilities of interest rate cuts that was already pricing in a strong probability in the October 29th decision. Also the 10th, but now it's a stone cold lock. 29th has a 99% chance we get another 25 basis point cut. And December 10th, we also are getting a nice 10% boost from yesterday. So just from yesterday to today, it went from 77% to 87% that we get yet another 25 basis point cut. So the market is pricing in 25 basis points in the next two decisions. Wipe our hands, SPX to 7,000. That's my prediction.
Because what could we hear from now until then that would
that's
you?
That's exactly what I've been looking at here, because since the 18th, since the Fed issued its announcement, you got 1 day of, hey, we got the cut from markets, and then everything stalled. And the dollar tellingly came up, yields came up. The markets clearly said this was not hawkish enough, or this was not dovish enough. And as you got some of those expectations loosening a little bit, especially for December, the markets went, whoa, hold on. 1 second here. What? And the S&P kind of stalled. And we had a little pullback there. We had a little pullback in the NASDAQ. To both of your points here, the defining feature of this rally today is a rebuilding of rate cut expectations. So the market here is basically praying for rain. It wants a weak economy because what it wants is the rate cuts. It's almost as if the market has said, you know what, bad things may happen. We may even want some degree of bad things to happen as long as the cheap money is coming to insulate us from whatever risks might arise. The cheaper the money, the better. Because then, sure, things might go wrong, but if the money's cheaper, then we can take a loss, borrow again, roll it again, and that's fine. As long as we have the bulwark of cheap money.
So then the disconnect to me is, we were talking about yesterday, is the Russell interesting? We kind of argued, hard to say moving with rate cuts. I don't know now, is this a confidence signal for you, Ilya, in the Russell, or not really the magnitude I would have expected if it was
not really. I would have thought that Russell would do better. I think one of the interesting things here today is the S&P is outperforming even relative to NASDAQ, in the sense that at least the S&P attempted to breach its swing high. NASDAQ didn't make it. But one of the more interesting things here, it's healthcare that's pushing this thing. That's easily by far the best performing sector today. And of course, it was the worst performing sector yesterday. So you get this. I mean, if we look at XLV here, it's basically all pinned on one thing, right? So you had this extended pullback in September, and over the past 2 days, it's just a fire hose. And this is not a macro story. This is a healthcare story. This isn't carrying over elsewhere. So you sort of wonder what this is. In particular, perhaps with the shutdown. I mean, that's not the part of the economy that's going to get terribly impacted.
Yeah, if you look at the S&P 100, some of the top movers the last couple of days, Eli Lilly, Merck, Pfizer, Amgen, AbbVie. So all these health-related or, pharma-related companies definitely seeing big moves. Merck looks exactly like XLK from a chart standpoint. Or not XLK. XLV.
And this is all on Trump RX?
I guess.
So, interesting thing here. I was looking at a list of furloughed federal employees as a consequence of this, the share of employees furloughed by department. So if you look at commerce, education, and the EPA, over 80% are furloughed.
Oh, wow.
Health and Human Services, 40%. Veterans Affairs, 3%.
Oh, wow.
So Social Security Administration, 12. So when you look at sort of this, the names that would be impacted by a shutdown, let's say insurers, hospitals, healthcare names, those parts of the government are not really shut down. That business is going to continue. I mean, Medicare, Medicaid, they're not getting turned off. I mean, rightly, of course. But those are vital enough that this shutdown doesn't go there. So yeah, I mean, there's been obviously a one-off catalyst here in healthcare, but at least in terms of doing no harm, the this is medical jokes. This sector is not a shutdown victim, you would think.
How much more does it got? I don't know. Is this, I mean, now we're back kind of in the middle of a range. It's broken out from its range, but is this still interesting?
I think it's interesting in terms of like a sector rotation, for sure. I mean, you have different sectors that make up the S&P, and one sector in particular has blown the roof off in terms of concentration and the gains on the year. So like, if we are to see this continue, could you see maybe a flattening of like the tech stocks and then a rotation into these other lagging sectors that would bring the whole thing up? I think that makes sense. I agree. I mean, but from an XLK standpoint, huge move over the last 2 days. The last 2 days, we went from basically 134 to 144, we'll call it 10-point range. If you look at future implied volatility in XL, do I keep saying XLK?
You do.
XLV. XLV. Where's the next 10-point move priced in? Not till the end of the year. So in 2 days, we've realized a move greater than the implied volatility priced into the next 80-day cycle. So sometimes.
So should we just sell this vol then?
Well, there's no vol. That's what I'm saying. There's no vol. This is just a move. This is a realized move that's not priced into vol. So if you're gonna trade this, I think you stay defined risk. I don't see any reason to sell premium in here when you can just buy options for $200 that are 90 days out. You could play for the upside or downside. I think that's where I would go. You could diagonalize it, do a zebra, something like that. But with sub 20% IV in a product that just moved 10 points in 2 days, I think that's where you go if you're trading this. Just defined risk directional.
And I would imagine in your mind, it's directional upside, especially given the strength of the breakout here.
Yeah, if you're playing for like a move back to 150, in theory, you could get that tomorrow. So,
I mean,
yeah, these options are cheap. Like these options are dirt cheap for a potential move back to recent highs. The markets are kind of wide. Could be just a fact that the market's closed, but tomorrow, I think it'd be interesting to check out, especially if there's a flattening of this move or maybe a little pullback, and you want to play for year-end XLV getting back to highs. It's a very cheap way to do it because the IV, although IV has increased into this move, 2.4% is nothing in the grand scheme of things. When you go from 15% to 17%, like this is a scenario where I don't care what IV rank is. IV rank could be 100. If IV ranks 100 and I look at the IV and it's only 20%, that doesn't really move the needle for selling premium. Like I want to see premium in the 50, 60% range, which you're not going to see unless there's a market meltdown. Like you only see the S&Ps and NASDAQ in the 50s or 60s when there's a market meltdown. Here, same story. It's kind of just look at the IV. If we're under 20% in any product, I'm going to lean more towards a debit strategy to define the risk and just play for a directional move.
It's how I end up a lot of times being long premium is vol is relatively cheap and you can get much better risk reward. I mean, you can basically lock in a 2-to-1 risk reward, sometimes better, risk defined. Why would you not do that?
Yeah. And I'm willing to bet, yeah, these options were basically worthless 2 days ago. These are trading for 20 cents. Now they're $2. So
Hence the IV rank.
exactly. Yeah. It's sometimes you have to always take everything into full consideration. And for a product like XLV, XLK, any of the XLs, I'm almost always going to lean towards long premium just because the premium itself is just not there. And you're still getting moves like this that will pay you off if you're directionally right.
Yeah, you can get really, IBIT actually is sort of similar to this, where you can get incredible risk reward just being long premium. I mean, sometimes like 3-to-1, 4-to-1, just because it's so cheap.
Mm-hmm. What else you got your eye on in this magical market, Ilya?
One of the most interesting things, and I don't know if it's time to attaboy myself yet, but at the very least, so we started this week with a conversation saying a shutdown, well, the scuttlebutt being a shutdown would be bad for the US dollar, and me arguing no, it wouldn't. It wouldn't be bad for the US dollar. And boy, did the dollar turn today. So it started off bad for the US dollar, again, in the overnight when European and Asian traders seem to be taking the shutdown at face value. But my God, the reversals. Euro couldn't make it stick at all. The yen probably had the best showing of the bunch today, but the euro couldn't make it stick. The Aussie couldn't make it stick. The pound gave away almost all of it. The Canadian dollar is actually down on the day. So is the franc. So you look at this thing and you go, well, why? Like, of all things, how is it that the dollar is holding up this strongly? I'm happy that it is, of course. I've been looking for it to bottom since July, so I'm long, and I'm staying long, and I'm getting more long. It hasn't made its move yet, but for all the dovish talk, for all of this apparent structural concern, the dollar is up. And in my mind, it's up because it's up for the same reasons that gold is up, interestingly, which is to say that there is a lot of uncertainty and defensiveness. And when you look at gold and this most recent rally, and silver too, it's been completely disconnected from yields and from the dollar, which are usually its catalysts. So if you look from mid-September, gold and silver rip at the same time that the dollar is recovering and yields are going higher after the Fed. So this is something else. This is not gold and silver being kind of the usual anti-fiat foil, the usual anti-interest rates foil, because of course they yield nothing. So this is something else. This seems like the market basically going, you know what? We don't know what's going on, and there's a bunch of idiosyncratic risk on the board. There's, well, maybe the president's tariffs are going to get overruled by the Supreme Court, and that would take 4 or 5 months of benchmarking in markets and toss them out the window. Maybe you have some sort of a Fed situation. It can go either this way or that, but just today we learned that the Supreme Court said Lisa Cook, the governor that the president is trying to fire, can stay at least until January, when her case is going to get looked at in oral arguments. So maybe there's some kind of a confrontation here where the president gets told, no, you can't infringe on Fed independence, and then all kinds of things follow on. there's just a lot that's up in the air. I would think the tariffs most significantly. And the market seemed to be going into some sort of a, you know what, where can we go to park some capital to not think about these things? And gold and silver stand out, and maybe the dollar too, because I think since April, the dollar has really found its groove as a haven once again. I think in sort of late March, early April, there was definitely that Liberation Day kerfuffle where stocks and bonds and the dollar were all going down at the same time because the markets were afraid that maybe the U.S. government has gone so crazy as to cut off its nose to spite its face. Like maybe it really does want to pull apart the architecture of the U.S. dollar and the treasury bond-based global financial system. And then the president backed off. And market discipline worked. And the president said, oh, whoa, 90-day pause. Hang on, everybody. Stop that. And then the China deadline got extended and extended again. And we got sort of semblances of deals with other main trading partners. Sans Canada, that's probably coming. So, I mean, we're running up to the renegotiation of the USMCA next year. It's not illogical that this one is a little bit feistier. So you get maybe a dollar haven bid again because the markets go, oh, they're not going to structurally undermine the dollar. Fine. It's still a haven. It's still the cash of choice. Its role in global commerce as the cash of commerce, that remains. And the U.S. is not going to shoot itself in the foot in this sense. So, okay, fine. I like the dollar here. It is defying any kind of news interpretation you might have, and that's a sign of even greater strength, I think.
Yeah, I mean, shutdown aside, with how clean the move was in, rate cut expectations, I was definitely surprised that we didn't at least see, some consistent skid throughout the day in dollar prices. Did get a bid back up throughout the U.S. session, not moving with those rates. Yeah, I think today and yesterday kind of contextualized this shutdown for me in an important way of thinking, of course it's not fun, but a dramatic headline to talk about government shutdown. But when you really think about what's burdened the U.S. dollar so far this year, what we're looking at right now is just a congressional disagreement that we've seen 20 odd times before. Nothing really as uncertain as what we've seen, from the administration early in the year, with all those tariff uncertainties, as well as the Fed independence piece that I think definitely hampered a dollar price action throughout the summer as well. And so those pieces staying put really have supported this stronger than I would have expected, with the news of, perhaps successive rates, very likely, as we talked about, most of that price action is now playing into 2026. Markets looking really far ahead in terms of what kind of the neutral rate will be for this cycle, as opposed to does the 1-2 cuts come October, December, October, January. I think it's the whole scope of the cuts that's the story now.
Definitely.
So, I think
definitely. I mean, to me, this has been the biggest deal, is that the markets and the Fed are far apart on next year. This year is kind of a given in a lot of ways because the calendar is so limited. And it was already so limited by September. I mean, they had 50 basis points on the board that they themselves predicted as of June. And by September, they had 3 meetings. There's only so many configurations to do this easing when you've got 3 meetings left. So whether they do 50
sans jumbo cut.
Well, sans jumbo cut. Exactly. And given how reluctant the Fed has been, jumbo cut was never something with serious odds. So you look at this and you go, okay, this year is kind of a given. The question is next year. And there's still a wide gap between the markets and the Fed. I mean, the markets are at 63 basis points for next year. And that's what, at least 2 cuts and about 50-50 on a third. And the Fed's at a quarter. That's it.
Hey,
they're only looking at 25.
Get your mortgage broker on the line. You might have an opportunity to refi, baby.
That's right.
We get down there.
It's an interesting thing because let's assume that we don't get NFP on Friday, right? Let's assume the BLS does not let us look at the numbers. Okay, ISM will still come out, so that'll be an employment indicator. The service sector ISM is obviously a huge thing for employment. It's by far the service sector, by far the biggest employer of Americans, and that will have some jobs data baked into it. And obviously today we have ADP, which is something that, Glenn, as you were mentioning, that came out either god-awful or great, depending on your perspective. God-awful in the sense that it was a 32,000 job loss that came out against expectations for a 50,000 jobs gain. The prior month was revised from a 54,000 jobs gain to a 3,000 jobs loss. So that's the 2 consecutive months now of job losses, according to ADP. And that's the first time that we've seen something like that since 2020. It's the first negative, or the largest negative reading since March of 2023, which was a one-off, just a weird month. But we haven't had back-to-back job losses from ADP since COVID, since basically the onset of COVID. So if this is the only data we're going to have, and ISM is not incredible, then the markets are, going to look at this and go, well, I guess the labor market is terrible. I guess the Fed's going to cut rates a bunch. BLS could have told us something different, but I don't know what I don't know.
It's true.
Yeah, I think the no bad numbers, no problem sentence is going to fly around for a little bit here.
Don't worry, no cry.
Yeah, the lack of numbers, lack of things that can turn this ship around. We're in for some low volatility times, I fear. I did put out a poll on the YouTube chat earlier today. My poll question was, what breaks first, the equity market or the metals? 66% said the equity market breaks down first, which I kind of agree with. All things said, I mean, if the narrative is there's fear in the market, we're placing cash into a product we trust, like gold and silver, or even Bitcoin, seeing a nice rally the last couple of days. I tend to agree that even though these moves have been so astronomical in gold and silver, and both of these also have exceeded implied volatility to the upside, I would be more surprised to see these come down to previous levels versus the equity market coming down to 6,300, 6,200, something like that.
Yeah, I mean, I think it's an interesting conundrum. I would think that if gold and silver were powered by the usual catalysts, if we were talking about yields, if we were talking about the dollar in particular, you'd think would be exerting some pressure here because it seems like it wants to turn. It seems to be shrugging off negative thing after negative thing. And if the metals were a foil for fiat currency, of which the dollar is the benchmark, full stop, you'd think, okay, herein is the danger. The dollar is building a bottom. It's going to have some sort of a rip. That rip might be because the economy actually looks like it's heating up, jobs data notwithstanding. I mean, the Atlanta Fed GDP now tracker is steeply climbing. The Citigroup index of U.S. economic data surprises is steeply climbing. So ADP, I'll save my words of disparagement for that indicator, but ADP notwithstanding, because it might actually matter this month, ADP notwithstanding, U.S. economic data has been relatively good, at least like compared with forecasts. And so, and what the GDP Now tracker is telling you, it's not telling you anything about GDP. Forget that. The important, I mean, that'll be for the third quarter, which is ages away still. It'll look very different by then. The important thing is you can see the trend in the model. So you can see that the data going into it has been GDP positive. That is relatively positive data. So you could say, okay, well, the risk to the metals is the rate cut calculus is wrong. The Fed is right. The economy is actually heating up. That's why they forecasted faster growth next year in the latest SEP. That's why they forecasted faster inflation, lower unemployment. They see it. The economy is actually accelerating. And because the economy is accelerating and the labor market is a lagging indicator, they're not going to need to do all the cuts that the markets think. There's your dollar catalyst to really go. And that could boost yields, that could boost metals. Or that could hurt metals. Right. But metals don't care about that here. And so actually, I think that narrative might be a bigger risk for the stock market, interestingly, than it is for metals. Because stock markets seem to have cared a lot more about, oh my God, just don't take away our rate cuts. We'll do anything. Please. We'll do anything.
Yeah.
Just don't take away our rate cuts. I mean, you see it just in the way that they've behaved sort of during and since the Fed. You're watching it here right now in real time. So if what's going to happen here is the data ultimately says you don't need this many rate cuts, the markets are out on a limb, the Fed's been right, they're not going to go that hard because the inflation risk isn't going away that quickly, and it isn't, then paradoxically, I mean, normally you would think that's a much bigger risk for gold than stocks. Right. But in this environment, I might actually think the tables have turned.
I think you're missing one piece to the puzzle here. Curious to hear your thoughts on it. Big mover of the day. We've talked dollar, we've talked gold, digital gold. What are you thinking about crypto? Crypto mover
I've been
of the
talking
day.
Smack about it all day.
And here we go.
He's the only crypto bear I know in the
Does that fold into any sort of calculus in that view? Do you see this moving completely separately from all of that?
I do. I think, well, so to me, crypto is up because stocks are up. Because to me, crypto is not gold. I mean, obviously. Just look at a chart of crypto, then look at a chart of gold. If crypto were the same kind of asset that gold is, this would not be a chart that's been stuck in a range since early August. It would be ripping, which is what gold is doing, which is what silver is doing, which is what other precious metals are doing. This is not gold. This is not a store of value asset. Nobody's confused. What this looks like, much more so, is the stock market only soggier because the stock market is doing better. So, I mean, overlay a chart of Bitcoin and the S&P, and you get basically a kind of lazy stock market over the past couple weeks because it's done less well than stocks have, generally. And so, to me, what this is a kind of barometer for risk appetite of the exuberant kind. And so there's a kind of gradient almost, like how risk on are we? Are we risk on to just buy stocks, or are we risk on enough to buy crypto?
I'd argue that it's risk on and with the flow of money, like how free are funds. less so a risk and more risk. But I think you do, if you're folding this into the rate cut story, these markets, these crypto markets, will be more lagged than a stock market, moving less on anticipation of lower rates sometime in the future, but here more would get more lift from the actual real-time effects of lower rate cuts, as we've seen time and time again.
Well, yeah, I mean, that's the other thing. To your point, that's the other thing. Crypto is not really responding here in a way that you'd think, oh, goody, so much liquidity is coming because the Fed is going to cut rates. It's not doing that. It's been stuck much along the same lines as the dollar has been bottoming. This has been struggling to rally. So in some sense, it is almost inherently being held back because it's priced in dollars, which is the great irony of ironies for this whole thing, right? Is it's not actually money. It's just it's just a speculative asset. And by the way, any pretensions it had to being money went out the window the moment they made ETFs out of it. So any kind of this is sort of like the original sin of crypto. Like, we're going to create an asset outside of where governments can mess with people's store of value. And then what we're going to do is give all the regulatory agencies say over all of it as a condition of giving it enough liquidity that would have made it a contender to be money in the first place. So without government's hand in it, it couldn't be liquid enough to be money. And when the only way to get it to be liquid enough was to get government's hand in it. It's not money. Certainly not alternative money.
We'll see. It's one for one. No government, crypto up. So
Hey.
We'll see how long it takes.
But to Ilya's point, yeah, strong positive correlation with IBIT to SPY, 0.4 correlation to SPY in the last 3 months. I would argue it's more correlated to tech stocks.
Yes.
But yeah, strong positive correlation. Still super volatile. And I think it holds a place in a total portfolio because of that volatility, for sure.
Sure. For a trader, especially.
Yeah. Absolutely. I mean, that's
now that you have ETFs that are on exchange and you don't have to think wallets and this, and you can basically look at this like any other ticker. Why not?
Yeah. But yeah, IBIT's been a great vehicle for short and long premium trades all year. But that's because it's had two-sided action, big swings in either direction. That's kind of what you need. But yeah, I think there was a question in the YouTube chat. Is there a scenario where both go down at the same time, equities and metals? Or do you think the metals move is so strong and the narrative is so strong for an anti-equity market play that you would...
There is a scenario, yeah.
What is that scenario?
The scenario is basically 08.
Yeah.
Like if you want to get a picture of what a dollar rally looks like, where everybody basically stops being able to sleep for a week, just look at what the charts looked like in the second half of 08, starting from about mid-July. Because this didn't begin with Lehman or anything like it. The markets turned earlier. The euro topped at around 160, basically mid-July, and of that year. And from there, just this relentless run into cash. And when you get a relentless run into cash, it doesn't matter if it's gold, if it's stocks, if it's crypto, if it's lean hogs, if it's soybeans, whatever, frozen OJ, you name it. Everything is just going to cash. Everything's just going to cash. That's it. People are just washing their hands. Because if you get to a situation like in 08, where the terror in markets is such that credit locks up, the biggest premium is on cash, because that's what you need to survive if you can't go to credit markets to get more cash. That's sort of the essence of the financial system. Everything runs on cash. You need a letter of credit to import things. I mean, virtually everything runs on the availability of credit to some extent. And if you can't get that, those with the cash survive and those without it die. And so that's really it. So if you get another credit squeeze, if the markets, for whatever reason, and by the way, it's not like we don't have the architecture for a credit squeeze. We just don't have any reason to think it's about to happen now because there's no signs of credit stress in markets to speak of. But it's not like global debt is not at record levels. It is. It's not like debt to GDP ratios are not at insane levels pretty much everywhere. They are. It's not like we don't have all the money that corporates took when rates were zero during COVID. It's not like all that money isn't rolling over right about now because it's mostly 5-year money. It's happening. It's a big risk. Rates are a lot higher. But for right now, there's just not a level of concern in credit markets. Could that concern emerge? Of course it could. Of course it could. And that would be a scenario where everything goes down at the same time. Correlations go to 1. Distinctions between assets and sectors, blah, blah, blah. All of that goes out the window. It's cash or bust.
Cash and Bitcoin.
And definitely not Bitcoin. Bitcoin in that environment can only hope for the magnanimity of the 5 hodlers that own most of it,
and have lost all their
because
their
that's
wallet
by the way
addresses.
that's
Can't
by the way
sell.
a fun little piece of decentralized finance is it's incredibly centralized.
Well,
incredibly centralized.
I must
Most
say,
Bitcoin is owned by a tiny handful of people, individuals.
Exactly.
to that point, though, during the April crash, we didn't see that big of a move in Bitcoin relative to other products. So I think there is something to say about the hodler narrative and how you could certainly see it at least stay more afloat than other products. But yeah, I mean, at the end of the day, it is positively correlated to the market. If everything's going down, you'd imagine that Bitcoin would be going down for the same reason we just discussed, of just cash over everything. Wait for the bottom to hit. Wait for your bigger players to tell us where the bottom is, and then you, in an ideal world, you can ride it back up. But
by the way, if you ever wanted to see me get aggressively bullish in an almost nauseating way, that kind of crash, I would buy everything.
Yeah. I mean, if you look, I just had a monthly 20-year chart of SPX. Like, it's comical to me because, like, here's 08. This is when I just graduated high school and I was just like, I don't know what I was doing. But here, 2020, you get your sell off. Everyone thinks the world is ending. 2 years later, how about we just double the price of SPX? Same thing here. Violent sell off in April, and we just slingshot the other direction. So it doesn't it just doesn't matter what the narrative is. And that's why we say, when volatility is really low, our position sizing is smaller. We have more cash on the side, because if we are fortunate enough to have a lot of cash on the side and get a move like this, where we go from 6,300 down to sub 5,000, and you have tons of cash on the side that you can start placing longer bets and getting static long shares of things, like even into a big volatility expansion in SPX or the Qs, if you're buying call options that are 2-3 years out that bring you back to all-time highs, all of those options have 7x, 8x, 10x since the bottom of April. So I'm totally on board. And the nice thing about these markets that move much faster these days is that if and when that happens, you can see the quick reversals to the upside. Like we saw it in one day, that historic NASDAQ day, where things were paused and the NASDAQ just immediately ripped up like 500 points. It was crazy. So yeah, I hear you.
Even I bought in April because it was just like this is madness.
Yeah.
There's your most reliable signal.
And I think the one important distinction that we need to make is when we're talking about buying and when you look at historic recoveries, we're talking about indexes, SPX, the NASDAQ. You can do the same thing in equities, but there are going to be equities that go down and never come back. So don't do the brushstroke of everything will recover. Not everything will recover. But
some things will die.
Indices.
Some things won't have the cash. Exactly. And they'll die.
Yeah. But indices where all of the money is flowing in a passive way and active way, those have recovered from even the most violent sell-offs. So that's why we say keep cash on the side, trade small, so that you give yourself the opportunity to partake in those moves when they happen. And yeah, that's it.
Well, I mean, so to preempt the natural next question, which is, well, what if everything really does break? Like what happened? Like we've had civilizational breakdowns before. It's not like we haven't. They don't call them the Dark Ages for nothing. We've had periods where things, I mean, world wars more recently, obviously. We've had periods. People are alive today that have lived through periods where the global financial order has come apart. The global financial order is only about 1973 and onward, when Nixon takes the dollar off the gold standard, finally. And sort of everything kind of organizes around that, and that's the world we live in now. So what happens if really the wheels come off the bus? And I mean, my counter to that is, well, you can't trade from a basis in Armageddon. Because if you're trading for Armageddon,
you're going to be upset. You're going to be upset for
first of all, many bad days.
I mean, the price of the S&P will be the least of your concerns if that were to be the scenario. The investable assets at that point are canned fish and ammo.
Bags of rice. I got one.
Yeah.
No one's getting it.
If you're really betting for Armageddon, what makes you think that you're going to be able to get to a market to place a trade and have liquidity? Yeah. I mean, if we're really talking about that kind of unraveling, all bets are off completely. So by engaging with current financial markets, you're kind of inherently saying, well, I'm engaging with this because Armageddon is not where I think this is going.
Correct.
Just philosophically.
Yeah.
Just to zoom in here before we get out of here, Ilya, we spoke yesterday about your SPX, your thoughts slightly bearish, and you said it'll be very quick. You know when you're wrong. Have we proved otherwise today, or do we still have a little more rope?
No, I don't think we proved otherwise today. I think we really were close, but that sell-off on the close
saved it,
pushed us back to this annoyingly indecisive spot where anywhere you look, S&P, of course, a case in point, you're back at the highs and you couldn't get over. It's the same in the NASDAQ. You're back at the highs, you couldn't get over. In Russell, you're a little bit soggier. You got back to the range top, as it were, where you've been consolidating since, let's call it about middle of last week. We established a range with a lurch down. And then since then, we've kind of held that range. Let's call it between about 24.70, 24.65, something like that. And the bottom at about 24.11, 24.15, something like that. So you're in this tight bracket. It's the same thing, only sort of more potent on the S&P in the sense that you're in a range. Today, you really tried to take that range out. It didn't work. It didn't work in NASDAQ either. And so, who knows? But show me a break and I'm out.
All right.
Because I'm not looking to stand in the way of something that is this level of momentum. It's the same idea that we talked about yesterday, Glenn, that essentially, if you look at this not as an investor,
Right.
whose view is, well, the AI supernova is what it is, and stock markets are biased higher, and I'll see you in 5-10 years. Like, whatever, it'll be higher. If your perspective is from a trading sort of, let's even look at the sort of regular tasty methodology, 45 days in. If you're looking at about 5-6 weeks here for a trade, is the risk reward better to be long or short when you are literally pinned at the high and struggling to get over? I mean, obviously the risk reward is to bet short, especially when vol is cheap. That doesn't mean you're going to be right. It just means you get better odds.
Yeah, I think that's
That's
fair.
all. That's all. I mean, I'm not super. Who could be philosophically bearish here when the market is telling you that it does not care?
Yeah. I mean, we had this 3-day window where my ears were perked up. I was like, okay,
Yes.
what is this now? And then this was rate cut day, I believe. We got the rate cut.
Mm-hmm.
And then they said, oh, down 50? How about up 50? And then today's move was crazy though. We were down, I looked last night, we were down like 30, 40. This is almost 100-point reversal from the bottom to the top. So to your point,
I was almost annoyed overnight.
Yeah.
Because we spent all week saying the shutdown doesn't matter, and then the shutdown happened, and the markets were down overnight. I'm like, oh, they decided to care. No, they didn't.
Gotcha.
Yeah, it's it'll be interesting to see where we go, but volatility is super low. The market seems like it wants to grind higher. Now the government shut down. The interest rate cuts are locked in based on probabilities. Things can change, but doesn't seem like they will. Bad numbers that could move markets are no longer being announced. So it's just like, I don't know what else to say. It's crazy.
You get a hot ISM number on Friday. Let's see what this does. But if it's not a hot ISM number and there is no NFP, there's nothing in the way.
SPX 7000, baby.
Here we
My
go.
Q4 guess is 69.69. So
Very nice.
close.
Book 'em.
Close.
And with that, gentlemen, overtime is out of time. Thank you as ever for joining us. Don't go anywhere. We'll be back in just a few seconds here for Macro Money, where I will talk about this jobs report, which maybe is coming out, maybe isn't. We'll see. And why it is that the markets seem to want a weak U.S. economy. So don't go anywhere. The government is shut down in the US, but the markets are up. Okay, how does that make any sense? And where's the Armageddon we were promised? And what's coming up next to infuse these markets with a little bit more directional conviction and where things might head? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do here is begin with a look at what the markets did today, why they appeared to do what they did, and sort of contextualize that in the sort of scope of what is occurring here with the government shutdown and maybe now less economic data risk for the week than we initially had in mind because of that shutdown. And look at some of the data that came out that might be a stand-in and what's still pending here to give us some kind of a steer if, in fact, we get to a situation where the jobs report that, of course, we were all waiting to see as a major injection of direction into sentiment, if, in fact, the government shutdown will mean that the Bureau of Labor Statistics isn't going to publish that on Friday, and then see what that might mean going forward. So let's first look at the way that these markets performed today. We can see a little bit higher on stocks ultimately. There was certainly a meaningful sell-off in Asian and European hours in the futures overnight, but that did not stick. Once U.S. markets came online, that sell-off was undone, and as we can see here, the S&P at one point was down almost 0.9%, and it finishes the day clearly in the plus column. So the sort of operative question here, really, once the shutdown occurred and markets got a chance to take a crack at what to do, overseas markets thought, oh no, this could be an issue. Once Wall Street came into the fray, negativity melted away, and we came off these lows. Now, what's interesting is that we didn't ultimately cross the swing high in the S&P or the NASDAQ in a closing sense, so we're still nominally in the same range that we've been holding here. But nevertheless, we're certainly not looking at the markets feeling terribly perturbed by this government shutdown. More interestingly, a yield down at the same time, the 10-year off, the 2-year off, in fact, most easing that's reflected in markets tends to be kind of anchored to the 2-year, and that's where the bulk of the move happens today, largely as Fed rate cut odds get firmer. We'll take a look at that here again momentarily, but as you look through this setup, you get a sense that indeed this does seem the most about what this shutdown might mean for the market's favorite bullish catalyst of late, Fed rate cuts. Now, it would be a bit disingenuous to say that gold is up for these reasons. Gold has been up regardless of relative recovery in the dollar since mid-September, a relative recovery in yields since mid-September. But gold's just doing what it's doing. It continues to edge up here, up 0.4%. But the dollar also not exactly one-sided. And there, Fed policy expectations are looking kind of curious because the yen, which is the most kind of directly yields driven of the major currency crosses for the dollar, it does see some gains as yields come in, up 0.5%. But the euro, which is a much better benchmark for the overall direction of the dollar, it was up overnight when futures markets were down and worried. But that is not what we're seeing here. It's given up all those gains, and not for anything euro idiosyncratic, not for any euro-specific reasons. You're seeing something very similar across the major currencies. The dollar is holding up very well. The yen is the only one really making a big move. The pound was up a lot more and is closing up just 0.25%. That's giving up almost more than half of its intraday gains. The Aussie is flat. The Canadian dollar is actually down. So is the franc. And so you're in a situation where the dollar is holding up impressively well, despite whatever this might mean for the structural integrity and the faith and credit of the U.S. government, if anything at all. Because clearly the response in markets here has been to actually buy bonds, hence the lower yields. And so in this kind of thing, we get the sense this is not some sort of a great sovereign risk type of thing that the markets are interpreting, at least for now. Instead, this seems more about what this could mean for Fed easing, and the markets want Fed easing. Looking at the way that things have performed so far this week, nominal gains of close to 1% for the S&P and NASDAQ, a little bit more for the NASDAQ, a little bit less for the S&P. Yields down across the board as we rebuild Fed rate cut expectations closer to where they were in the immediate aftermath of last month's policy meeting. Again, a little bit of a soggier view on the dollar, and that seems to be mostly coming today and yesterday, but not really anything that's gaining significant traction. Now, as far as the government shutdown is concerned, this is a handy chart from the New York Times that shows us how many federal workers are furloughed as a consequence of this, and it helpfully breaks it down by share of department. And really the message here is that the most essential things, Medicare, Medicaid, defense, the DOJ, most of this, Homeland Security, relatively low impact. So the Treasury, only 2% of that workforce is furloughed. Justice Department, only 11%. The EPA, or the Department of Education, over 80%. Now, of course, this gives you a sense not only of the administration's priorities, but also of what are kind of the bare minimum things that need to function. But it does also give you a sense that the economic impact of any kind of shutdown is a long arc. It'll take a while for there to be some sort of meaningful data impact, and that's if the shutdown lasts. We saw the longest one at about 35 days in 2018, and that didn't really move the needle on the economy, but for some episodic pockets here or there that quickly got rebased in the data. So we're looking not so much at the ceiling caving in on the U.S. economy as a kind of headwind, a gradual headwind to economic activity that, from the market's perspective at least, probably means more rate cuts. Now, in so much as we may not get the jobs report this Friday from the Bureau of Labor Statistics as a consequence of this, one data point that typically is not a very good predictor of official numbers, but which for the purposes of this week, if we don't get official numbers, might be our best benchmark. One source of support for markets today, interestingly, in this rate cuts heavy environment, was the jobs report on private sector payrolls from ADP, which is a big processor of HR information and payrolls and so forth. And what we got here was unexpectedly a drop of 32K against expectations of a 50K gain. Moreover, the prior month was revised down from a 50K plus rise, 54K, to a 3K loss. And so what you end up with here then is 2 consecutive months of job losses, according to ADP, for the first time in 5 years, which of course takes us back to COVID and the shutdowns and the rollout of the pandemic. It's the biggest decline since March of 2023 on a given month. That's this right here. But as we can see, that was kind of a one-off. There was some sort of idiosyncratic thing that happened here. But you can see the pace of job gains was about this. So let's say averaging around 110, 120K in this period. So this was the biggest drop since then, but this is not exactly the world's most relevant kind of macro touch point and reference point to say, well, what was happening in the world then was X. This is the biggest decline since then. Are we back at X? It's not that kind of a reference point, and this is not the kind of thing that we seem to be looking at. This seems more like some sort of building momentum slowly for job cuts, and slowly is really the key here. These very modest declines, a mass layoff, this is not across the economy. But nevertheless, it's enough sogginess that the markets might be hopeful for rate cuts. The service sector lost to 28,000 jobs, according to this, with most of that being leisure and hospitality, as well as professional and business services. Those were down 19,000 and 13,000 each. There was some gain to be had in education and health services, 33,000 added there. On the goods side of things, the sector lost 3,000 jobs, where construction and manufacturing were the biggest losers, 5K and 2K each. So it looks like the numbers were soggy, but not catastrophic, and that seems to be the sweet spot for the markets here, because what they want is rate cuts, but not economic Armageddon. It was a similar story from the ISM manufacturing report, which again takes on added significance. The Institute of Supply Management is not going to be impacted by these shutdowns. So it'll be interesting to look at what this is, of course, because we have a apparent closure of the government impacting BLS. And so these surveys, the manufacturing and the service sector survey, which comes out on Friday, they have in them an employment component. And because they have an employment component, this might be, sort of in addition to these ADP numbers, a way to get a sense for what's happening with the Fed's new favored bogey, absent the BLS data. And so in that sense, we might have a situation here where this too could start to take on some added significance. And we can see here that at least for the manufacturing side of the equation, we have a relatively benign outcome. It's still a contraction, as ever. This is in the logic of PMIs, where 50 is neutral, above 50 is growth, below 50 is contraction. The further we get above 50, the faster the growth. The further we get below 50, the faster the contraction. And we can see here what we've been looking at essentially since we started to normalize off these heady levels during the catch-up from COVID. This was COVID, obviously. Big, sharp contraction, then a rapid reacceleration as we caught back up, and then that moderated to sort of a more normal pace, and we've established a kind of range for where growth is at this point since about the middle of 2023. And the story there has been of contraction in manufacturing and of a service sector that's kind of holding the economy up. And we're still looking for that service sector number on Friday, but the manufacturing sector number at 49.1, almost exactly in line with the forecasts that were out there. Still a contraction, but the most narrow contraction since the last time that there was growth, or modest growth anyway, at the beginning of the year. So here was this kind of blip, January and February, where we briefly got into expansionary territory on manufacturing. This has been the slowest contraction since then. And if we look at the internals, the price index came down a little bit more. That's encouraging in the sense that inflation pressure eased a little. Employment still deep into contraction territory, where it's been since basically the beginning of the year. But again, the pace of contraction easing. So the market seemingly looked at this again and said, well, falling employment, easing inflation, weak ADP numbers. Sounds like the recipe for the Fed to keep cutting, and to cut in a way that is maybe a little bit more robust. And that's exactly what we see here. The outlook for rate cuts over the rest of this year and next, edging into a more dovish direction. We now have 39 basis points on the board for this year. That's net of the 25 basis points that we've already seen. Then for next year, we're at 64 basis points, and we can see the total tally here shifted back to over 100 basis points, so over 1% in rate cuts. That's the first time that we've been all the way out here in about a week. Markets were a little bit soggier. They, in fact, started this week with only 93 basis points on the board, and obviously we've shifted some. The view for this year has become the most dovish it's been since that rate cut in mid-September. And so what the markets ostensibly are saying here is that the likelihood for October is locked in. No big shock there. We knew that was coming. It's now 99% versus 96% chance of a cut. December has firmed up. It is now at 87% versus 77% yesterday, almost 88%. So it looks like we're going to get these two cuts. But the biggest disconnect still is next year. If we take a look at what the Fed was forecasting when it made its announcement in September, it's got the three cuts there. And as we can see with what happened with yields and what happened with the dollar since this meeting, yields have been down, or yields have been up rather, bonds have been down, and the dollar has been higher. The markets knew that this was coming. They had most of this already priced in. Now, the probabilities weren't as high, especially for December. But the markets had the three cuts already there. So this modest adjustment here from 3.9 to 3.6, from 50 basis points to 75 this year, or from two cuts to three, that really didn't tell the markets much of anything that they didn't already know. The biggest disconnect is for 20 to 26, and of course the year thereafter, but that's far away, and all kinds of things can happen in between now and then. So let's focus speculation on next year. This is only a single rate cut. From 3.6 to 3.4 is 125 basis point cut. The markets clearly think there's going to be at least two. That would be 50 basis points out of 64. And then at 14 basis points baked in the direction of that third cut, we're talking about a probability of that cut of 56%. So just a tad better than even. About a 50-50 shot that there's the third cut, which obviously is miles apart from where the Fed is by at least a cut, maybe two. Now, what's interesting about all of this and why it matters, we can see that once we started to claw back in the wake of the September FOMC meeting, some of this easing, stock markets stalled. They're up today, not surprisingly, because we get a little bit more easing into the mix. And so we're back up at the highs. But this reversal in Fed policy odds in excess of just the one cut, because of course we can clearly see here going from 140 even to 100 basis points is more than a 25 basis point shift. So this is not just taking 25 basis points out of the outlook because they've already occurred. About another whole cut has fallen out of here. And so when you start to put it back in here, the markets seem to like it. It's the flip side for the dollar, which, as we just said, has been recovering since the Fed. But you get this dovish tick, and especially in the yen, as we said earlier, you get the dollar a little bit on the defensive, though it is still holding these lows from July and still seemingly attempting to bottom, dovish speculation notwithstanding. So if we do get a jobs report, we'll see. Some of these shutdowns have been resolved within a single 24 hours, so maybe we'll still get it. That's looking like a 50K gain in the forecast if we see it. The unemployment rate seen holding at 4.3%. Non-controversial numbers at face value. The risk, of course, if the markets are primarily wanting rate cuts and are okay with a weaker economy and want weaker data, is that they may not get it. The direction for U.S. economic data, looking at the City Surprise Index, has been to surprise on the upside increasingly since July. That probably comports nicely with the dollar's attempt at bottoming. And so we can see here that U.S. economic data increasingly beating relative to expectations. Moreover, if we look at the Atlanta Fed's GDP Now model, we can see, never mind what it says about third quarter GDP, that's still ages away, and the model is going to change a bunch between then and now. But more importantly, we can see in the trajectory of this GDP estimate whether incoming data that feeds it every day or every other day as the data comes out, whether that data has been GDP positive or GDP negative. And clearly the model has been GDP positive. The slope of this green line is very easy to discern. And so as we look at this then, we get the sense that U.S. economic activity actually seems to be heating up, not cooling down. And the labor market is, as ever, lagged. So if the Fed is focused on the labor market and that's old news and the economy is in fact reheating, well then scope for easing is going to be undermined. And this is why the markets really don't want to see a hot NFP number if they get any NFP number at all. But of course ISM does come out on Friday regardless. And that's the service sector, which employs the lion's share of the economy. If that is going to be firmer, especially on the jobs front, then you're not going to have a lot of scope for easing that the markets can really hang their head on. And that can start to look like basically what we've seen in the wake of the FOMC meeting. Soggier stocks and a firmer dollar. And so that's how I'm positioned here still. I haven't done anything with my exposure today. I'm still long the dollar against the Aussie, the pound, the euro, and the Canadian dollar. I still have a little bit of a tactical bearish exposure to stocks, basically just on risk-reward grounds. They're pinned near recent swing highs, and so it's better risk-reward to look for a pullback than otherwise. So I have a little bit of a put vertical exposure in the Russell, the S&P here, and in the NASDAQ. I'm doing it through ETFs just to keep sizing relatively modest and to keep these things cheap so that if they go wrong quickly and not in size. Still long silver, which continues to power higher, and still long the bonds, which was an attempt to buy the dip after the Fed, and that seems to be going okay. The way that I did this was to buy the 89 call and do it as a vertical to keep risk capped, and that seems to be working a bit. And that is the exposure that I will go into the end of the week with here. And then we'll see how it all shakes out, whether we get the data or we don't. And that is Macro Money for today. As ever, we are here right after Overtime, a show I co-host typically with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise commenting at Ilya Spivak on former Twitter and on Blue Sky, and writing for the News and Insights portion of tastylive.com. If you're watching this on YouTube, like and subscribe. Macro Money is back next week. Thanks for watching. Happy trading. We are back. That's Mr. Mike Butler in Chicago. Glenn Freiberg is with him. I'm Ilya Spivak here in San Francisco. Glenn, am I pronouncing your last name correctly?
Freiberger. Yeah, it's phonetic.
There we go. There we go. Not good with the names.
That's all right. You can just
ask
call
me who
G-Money.
the deputy governor of the BOJ is. I might actually have an answer for you, but real people names? That's not my department.
Freiberger with an A. That's what I say.
There
Ain't
it is.
J.
That works.
How's it going, gentlemen?
Yeah. So the government's shut down. Market
Apparently,
actually,
yes.
Market actually sold off a little bit into the close. Interesting.
Yeah.
Glenn actually brought up some interesting data points earlier today related to how market shutdown could be bad for US dollar in the short term, not so bad for equity markets. It's interesting.
But of course,
this is sort of the essence of what we've been talking about this week, right? In anticipation of this thing going down, is do the markets actually care about any of this? And it seems like even at the onset, I mean, obviously going into this overnight, I mean, futures were down all night. So Europe didn't like it. Asia didn't like it. We had some pretty hairy wicks. I mean, if we look at the S&P here, we can see that overnight things were definitely a little spicy. So looking at sort of where we got the S&P at one point, S&P futures, ES, was down something like almost 1%, like maybe 0.9% from the close yesterday. But obviously, we are not doing that here. So U.S. markets seem to come in and think, yeah, this is nothing. This is fine. Is this just because we're expecting for all of the posturing to eventually give us an answer? I mean, I think Westwater had a great chart that he's been sharing all week that basically says the longest shutdown was the 30-plus days in 2018, and markets were up. So ostensibly, is the framework here then, well, if it's within 30 days-ish, then we've seen this movie before and it's not painful. So I'll see you in a month? Is that what this is?
I mean, I would take it one step further and say that even the last occurrence, 35 days, I mean, that was a long time. And so
Yes.
I wouldn't necessarily be looking at a month. I'd honestly be looking at next week. I think we knew that this was coming as far as economic data not getting non-farms this week. We got a number today from the private ADP.
Did we ever?
And we're pricing in now for pretty certain a cut in October and not needing another data point to confirm or deny that. I think everyone's comfortable with thinking that the Fed is comfortable with that. And so I would look to next week, just because in looking at the previous, 20 shutdowns, the median duration of it is 3 days, and the mean being, I think, around 8. And that's skewed heavily by the last occurrence.
By the 35,
and a couple others that lasted 2 weeks, roughly. And so I'm looking at next week just to see if this is one of those blips. Okay, we needed everyone to get on the same page, pass whatever we were close to, or if there really are holdouts and we end up with a continuation package that isn't what people are expecting. That's the only thing I'm thinking of, not playing in the consensus right now.
Yeah, I mean, markets are drifting higher, volatility getting crushed. The prediction markets have this shutdown lasting. 90% of the probability based on betting markets is at the very least October 6th to 9th. And then it's about a 30% chop between that week, the week after, or the October 15th or later selection. So 90% of bettors are saying it will last till the 6th.
So a little weekend retreat.
Yeah.
Get all your ducks in a row.
Yeah.
Come with your answers on Monday.
Yeah. To Glenn's point, though, the CME FedWatch tool, where we look to gauge probabilities of interest rate cuts, that was already pricing in a strong probability in the October 29th decision.
Yeah.
Also the 10th, but now it's a stone cold lock. 29th has a 99% chance we get another 25 basis point cut. And December 10th, we also are getting a nice 10% boost from yesterday. So just from yesterday to today, it went from 77% to 87% that we get yet another 25 basis point cut. So the market is pricing in 25 basis points in the next two decisions. Wipe our hands, SPX to 7,000. That's my prediction.
Because what could we hear from now until then that would dissuade you?
Yeah.
That's exactly what I've been looking at here, because since the 18th, since the Fed issued its announcement, you got 1 day of, hey, we got the cut from markets, and then everything stalled. And the dollar tellingly came up, yields came up. The markets clearly said this was not hawkish enough, or this was not dovish enough. And as you got some of those expectations loosening a little bit, especially for December, the markets went, whoa, hold on. 1 second here. What? And the S&P kind of stalled. And we had a little pullback there. We had a little pullback in the NASDAQ. To both of your points here, the defining feature of this rally today is a rebuilding of rate cut expectations. So the market here is basically praying for rain. It wants a weak economy because what it wants is the rate cuts. It's almost as if the market has said, you know what, bad things may happen. We may even want some degree of bad things to happen, as long as the cheap money is coming to insulate us from whatever risks might arise. The cheaper the money, the better, because then, sure, things might go wrong, but if the money's cheaper, then we can take a loss, borrow again, roll it again, and that's fine, as long as we have the bulwark of cheap money.
So then the disconnect to me is, we were talking about yesterday, is the Russell interesting? We kind of argued, hard to say, moving with rate cuts. I don't know now, is this a confidence signal for you, Ilya, in the Russell, or not really the magnitude I would have expected if it was
not really. I would have thought that Russell would do better. I think one of the interesting things here today is the S&P is outperforming even relative to NASDAQ, in the sense that at least the S&P attempted to breach its swing high. NASDAQ didn't make it. But one of the more interesting things here, it's healthcare that's pushing this thing. That's easily by far the best performing sector today. And of course, it was the worst performing sector yesterday. So you get this. I mean, if we look at XLV here, it's basically all pinned on one thing, right? So you had this extended pullback in September, and over the past 2 days, it's just a fire hose. And this is not a macro story. This is a healthcare story. This isn't carrying over elsewhere. So you sort of wonder what this is. In particular, perhaps with the shutdown. I mean, that's not the part of the economy that's going to get terribly impacted.
Yeah, if you look at the S&P 100, some of the top movers the last couple of days, Eli Lilly, Merck, Pfizer, Amgen, AbbVie. So all these health related or pharma related companies definitely seeing big moves. Merck looks exactly like XLK from a chart standpoint, or not XLK, XLV.
And this is all on Trump RX.
I guess.
So, interesting thing here. I was looking at a list of furloughed federal employees as a consequence of this, the share of employees furloughed by department. So if you look at commerce, education, and the EPA, over 80% are furloughed.
Oh, wow.
Health and Human Services, 40%. Veterans Affairs, 3%.
Oh, wow.
So Social Security Administration, 12%. So when you look at sort of the names that would be impacted by a shutdown, let's say insurers, hospitals, healthcare names, those parts of the government are not really shut down. That business is going to continue. I mean, Medicare, Medicaid, they're not getting turned off. I mean, rightly, of course. But those are vital enough that this shutdown doesn't go there. So yeah, I mean, there's been obviously a one-off catalyst here in healthcare, but at least in terms of doing no harm, this is medical jokes. This sector is not a shutdown victim, you would think.
How much more does it got? No, is this, I mean, now we're back kind of in the middle of a range. It's broken out from its range, but is this still interesting?
I think it's interesting in terms of like a sector rotation for sure. I mean, you have different sectors that make up the S&P, and one sector in particular has blown the roof off in terms of concentration and the gains on the year. So like, if we are to see this continue, could you see maybe a flattening of like the tech stocks and then a rotation into these other lagging sectors that would bring the whole thing up? I think that makes sense. I agree. I mean, but from an XLK standpoint, huge move over the last 2 days. The last 2 days, we went from basically 134 to 144, we'll call it 10-point range. If you look at future implied volatility in XL, do I keep saying XLK?
You do.
XLV. XLV. Where's the next 10-point move priced in? Not till the end of the year. So in 2 days, we've realized a move greater than the implied volatility priced into the next 80-day cycle. So sometimes.
So should we just sell this vol then?
Well, there's no vol. That's what I'm saying. There's no vol. This is just a move. This is a realized move that's not priced into vol. So if you're gonna trade this, I think you stay defined risk. I don't see any reason to sell premium in here when you can just buy options for $200 that are 90 days out. You can play for the upside or downside. I think that's where I would go. You could diagonalize it, do a zebra, something like that. But with sub 20% IV in a product that just moved 10 points in 2 days, I think that's where you go if you're trading this. Just defined risk directional.
And I would imagine in your mind, it's directional upside, especially given the strength of the breakout here.
Yeah, if you're playing for like a move back to 150, in theory, you could get that tomorrow. So,
I mean,
yeah, these options are cheap. Like, these options are dirt cheap for a potential move back to recent highs. The markets are kind of wide. Could be just a fact that the market's closed, but tomorrow, I think it'd be interesting to check out, especially if there's a flattening of this move or maybe a little pullback, and you want to play for year-end XLV getting back to highs. It's a very cheap way to do it, because the IV, although IV has increased into this move, 2.4% is nothing in the grand scheme of things. When you go from 15% to 17%, like, this is a scenario where I don't care what IV rank is. IV rank could be 100. If IV ranks 100 and I look at the IV and it's only 20%, that doesn't really move the needle for selling premium. Like, I want to see premium in the 50, 60% range, which you're not going to see unless there's a market meltdown. Like, you only see the S&Ps and NASDAQ in the 50s or 60s when there's a market meltdown. Here, same story. It's kind of just look at the IV. If we're under 20% in any product, I'm going to lean more towards a debit strategy to define the risk and just play for a directional move.
It's how I end up a lot of times being long premium is vol is relatively cheap and you can get much better risk reward. I mean, you can basically lock in a 2-to-1 risk reward, sometimes better, risk defined. Why would you not do that?
Yeah. And I'm willing to bet, yeah, these options were basically worthless 2 days ago. These are trading for 20 cents. Now they're $2. So,
hence the IV rank.
Exactly. Yeah. It's sometimes you have to always take everything into full consideration. And for a product like XLV, XLK, any of the XLs, I'm almost always going to lean towards long premium just because the premium itself is just not there. And you're still getting moves like this that will pay you off if you're directionally right.
Yeah, you can get really IBIT actually is sort of similar to this, where you can get incredible risk reward just being long premium. I mean, sometimes like 3-to-1, 4-to-1, just because it's so cheap.
Mm-hmm. What else you got your eye on in this magical market, Ilya?
One of the most interesting things, and I don't know if it's time to attaboy myself yet, but at the very least, so we started this week with a conversation saying a shutdown, well, the scuttlebutt being a shutdown would be bad for the US dollar, and me arguing no, it wouldn't. It wouldn't be bad for the US dollar. And boy, did the dollar turn today. So it started off bad for the US dollar, again, in the overnight when European and Asian traders seem to be taking the shutdown at face value. But my God, the reversals. Euro couldn't make it stick at all. The yen probably had the best showing of the bunch today, but the euro couldn't make it stick. The Aussie couldn't make it stick. The pound gave away almost all of it. The Canadian dollar is actually down on the day. So is the franc. So you look at this thing and you go, well, why? Like, of all things, how is it that the dollar is holding up this strongly? I'm happy that it is, of course. I've been looking for it to bottom since July, so I'm long, and I'm staying long, and I'm getting more long. It hasn't made its move yet, but for all the dovish talk, for all of this apparent structural concern, the dollar is up. And in my mind, it's up because it's up for the same reasons that gold is up, interestingly, which is to say that there is a lot of uncertainty and defensiveness. And when you look at gold and this most recent rally, and silver too, it's been completely disconnected from yields and from the dollar, which are usually its catalysts. So if you look from mid-September, gold and silver rip at the same time that the dollar is recovering and yields are going higher after the Fed. So this is something else. This is not gold and silver being kind of the usual anti-fiat foil, the usual anti-interest rates foil, because of course they yield nothing. So this is something else. This seems like the market basically going, you know what? We don't know what's going on, and there's a bunch of idiosyncratic risk on the board. There's, well, maybe the president's tariffs are going to get overruled by the Supreme Court, and that would take 4 or 5 months of benchmarking in markets and toss them out the window. Maybe you have some sort of a Fed situation. It can go either this way or that, but just today we learned that the Supreme Court said Lisa Cook, the governor that the president is trying to fire, can stay at least until January, when her case is going to get looked at in oral arguments. So maybe there's some kind of a confrontation here where the president gets told, no, you can't infringe on Fed independence, and then all kinds of things follow on. There's just a lot that's up in the air. I would think the tariffs most significantly. And the market seemed to be going into some sort of a, you know what, where can we go to park some capital to not think about these things? And gold and silver stand out, and maybe the dollar too, because I think since April, the dollar has really found its groove as a haven once again. I think in sort of late March, early April, there was definitely that Liberation Day kerfuffle where stocks and bonds and the dollar were all going down at the same time because the markets were afraid that maybe the U.S. government has gone so crazy as to cut off its nose to spite its face. Like maybe it really does want to pull apart the architecture of the U.S. dollar and the treasury bond-based global financial system. And then the president backed off. And market discipline worked. And the president said, whoa, 90-day pause. Hang on, everybody. Stop that. And then the China deadline got extended and extended again. And we got sort of semblances of deals with other main trading partners. Sans Canada, that's probably coming. So, I mean, we're running up to the renegotiation of the USMCA next year. It's not illogical that this one is a little bit feistier. So you get maybe a dollar haven bid again because the markets go, oh, they're not going to structurally undermine the dollar. Fine. It's still a haven. It's still the cash of choice. Its role in global commerce as the cash of commerce, that remains. And the U.S. is not going to shoot itself in the foot in this sense. So, okay, fine. I like the dollar here. It is defying any kind of news interpretation you might have, and that's a sign of even greater strength, I think.
Yeah, I mean, shutdown aside, with how clean the move was in, rate cut expectations, I was definitely surprised that we didn't at least see, some consistent skid throughout the day in dollar prices.